Good morning, good afternoon, good evening, everyone. Can you hear me? If you can hear me, can you just write where you are from in the chat window so that I can see where you from? All right, so great, thank you. Singapore, lots of people in Singapore, UK, Kenya, Malaysia, Saudi, Hong Kong, Sydney, Italia, Borneo, Bulgaria, US, Canada, Melbourne, Germany. Wow, so many of you. Thank you. Thank you, appreciate. Thank you so much. I hope you can see me as well. And I'm now sharing my screen. You can see my screen as well, right? I hope, yeah? All right, so good. So happy weekend, everyone. Happy weekend. I know that many of you calling from different time zones, right? Some of you could be very early in the morning. Like today, I just saw some people calling from Europe, UK, and you say it's very early in the morning. Thank you for your commitment. For those who are calling from North America, like Canada and the US, I know it's the late timing for you. I appreciate your commitment to stay with me and with Adam earlier and with me right now. And I really appreciate it. And lots of people in Asia as well. So welcome. Thank you for using your weekend time to learn, and hopefully you will earn a lot from this onwards, right? And thank you for your overwhelming support and your commitment as well. I cannot wait to share with you what I know, what I've been doing so far so good, especially this year. And I show you some of the trading result as well. And then one particular powerful option strategy that I've been using a lot in this year, and that contributed a big chunk of my profit in this year. I will share with you on those as well. I hope yesterday you have enjoyed the webinars from Adam and Alson, right? And earlier today, Adam also talked about option, some basic concepts, some of the basic strategies, like selling a cash-secured put, like selling cover call, like selling bull put spread. I tell you, we have a lot more for you, right? So today I will focus on one, all right? So let me share with you my PowerPoint. I forgot to put up the PowerPoint here, yeah? So before I start, let me just to be clear, right, on the disclaimer, I'm not a qualified financial advisor, nor financial, planner or anything. I am just a normal guy doing options for many years, 18 years now. And I've been teaching option as well. And I found that this is a very powerful tool that you should know, in my opinion, you should know to magnify your wealth, right? So I'm not going to tell you or advise you what to do, right? I just show you what I've been doing, which works very well for me. And we have another trade hunt on Wednesday as well, where we go hunting together to search for good, animals to shoot or to bring home some of the good rewards after that. So hopefully we have a good time on Wednesday as well, because the market will open at that time. Right now it's in the weekend, so the market is closed. So most of my presentation today is on the theoretical part, and mostly like sharing with you what I've been doing. All right. So it's more like on educational purpose rather than advising or trade call or anything like that, right? So on agenda, right, I will talk about how to use options to boost your return on investment, or ROI, that's what I call it, in this particular market environment, right? And within that, I will focus today on only one option strategy, one. And I tell you, we have 20, yeah? Between level 1 and level 2, we have 20 strategies. And then we keep adding more, right? I'm the one who invented quite a few strategies now. I'm testing in the pipeline a few as well. So if you join this community, you will learn more along the way. But for today, I will focus only one option strategy. And it's not like full-fledged of teaching, but the concept, and how this option strategy has been doing for me in this year, right? This option strategy has a power that allows you to earn while you're waiting, right? So you can apply on the stock that is going nowhere, right? And you continue to earn money when it goes sideways. But when it starts to rally, it has tremendous upside potential. And I will show you some of the numbers later, right? So in particular, I will show you how to construct the trade. What are the optimal entry and exit rules? What are the benefits or the watch outs when you do this strategy? And particularly at the end, I show you my own experience using this strategy. Now, after that, at the end of the day, I will share with you my top 3 AI stocks for trading using this particular trading ideas, right? So today we can do the trade analysis and every simulation, everything. But on Wednesday, when the market opens, we can check back on the theoretical part, the simulation part. If the trades are still valid, we will enter together. And not just these 3, we go beyond that. We go many more. And I will look forward to receiving more ideas from you as well. So you send in your own trade ideas and you let me know. And I will go through it and I will analyze, hopefully many of them. And then if the trades are good, I will enter the trade live in front of you using my own real money, not even like paper. I don't do with paper, but I know that for those of you who are new, who are still not like experienced yet, it's okay for you to just practice with your paper account, right? But for me to get the skin in the game, I need to do with my real money, all right? So that's how it works for me. And then towards the end, I will have the live Q&A session. Of course, you can always send in your questions in the Q&A tab, not the chat tab, right? The Q&A tab. In the Q&A chat tab there, just write in your questions. And then at the end, I will go through many of them. I know along the way, the coaches, my colleagues will be there. I mean, for some of the questions you send in, they could help me answer as well, but I will cover many of them later on, right? All right, so without further ado, let's get into it. So a little bit on my introduction here. So Adam talked about a little bit this morning that I've been working for Procter & Gamble for almost 30 years, so to be exact, 28 years, right? But before that, I worked 4 years in another company, so 32 years in total. And I have recently decided to retire early. I'm still very young, but I retired early as of end of June, so just like 2 weeks ago. I think it's the right time for me to move on and do the only, trading and training by myself. I can continue to do both, right? Daytime and do Procter & Gamble works with getting more heavy. But at the nighttime, I can do trading, and weekend I do training and stuff like that. But I'm getting old, right? So I also need to be balanced with other things that I need to do, right? So I decided to focus on option trading and also teaching our students, reach out to many of you, and hopefully, just share with you what I've been doing, and hopefully that makes money for you as well. So I officially retired, but I'm still very active because I trade every single day when the market opens. And of course, weekend, I also do some trade, simulations, testing new strategies, developing new stuff. So busy enough, right? I've been partnering with Adam and his team over the past, I don't know, maybe 8 years, 7, 8 years. And I currently the options trading strategist at Prira Profits. I have 23 years of trading experience, in which 18 years on option trading. Because I got to know options about 18 years ago. Before that, I traded stock. But since I know options, no more stocks. Okay, 100% of my trading today is on, using options. None are stock, right? None are stock options. None are stock trading. And the last 7 years, I also do a lot of option coaching and training beyond the on-demand package that we're going to offer you today. I do have the live class. So I teach people live via Zoom, and we call it master class. That's the highest level of option training, right? And then I do have the subscription business, which is Option Tactics Playbook, which is OTP, right? So some of you may have heard about that, right? So question is, why do I like trading options? Well, very simple. And this is based on my real experience. Option help me magnify the return on investment. What kinds of return on investment we are talking about? I will show you later, right? Show you some numbers later, but have been working very well for me in many years. Number two, the power of options. You can use option in different scenarios when market is bullish, bearish, or sideways. Adam touched on it earlier today, so I don't want to cover a lot on this. And finally, I find that option trading is also very suitable for different traders' profile. If you are a super busy professionals, like I did over the past many years, when the full-time job was very busy, but I still can trade for myself using options. Or you want to be active traders, full-time traders, that can work as well, can work very well as well. And then finally, I find it's very interesting. Some of you may not have a big account to start with, right? You start with the small savings. I tell you, option is the way for you to magnify your return on investment and build your wealth faster. That's how I experience myself, right? Because yes, you can invest in stock and it can help you sleep very well. But overall, right, if the market just doing as a normal year, it generates about 12%, 13% a year. If you pick the good stock, like Adam normally can do it, you could get like 25%, 30%. But I tell you, option can give you a lot more than that, right? Now, you're asking, I am taking a lot more risk. To be honest with you, no, I don't think so. I don't think I take more risk because it really depends on what option strategies you are using. The one that I'm going to teach you today actually helps reduce the risk, not even increasing it. At the same time, it boosts your return on investment. All right, stay with me on that. Sneak peek on my trading accounts. Okay, my main trading account has been doing quite well this year so far, as of last Friday, July 14, right? So this account, I started at about $217,000. And as of last Friday, I grew it to $500,000. All right. So in a little more than 6 months, I have gained 130%. All right, 130% from $217,000 to $500,000. Right, so market has been performing well, but SPX is up by, S&P 500 has been up by, I think, 17%. I think NASDAQ is doing better, something like 42% something. But with options, you can see that I can do more, I can do better, right? So, and I can show you live as well. Let me see if it works here. So this is the account that I'm talking about, the main trading account. And by the way, I use Thinkorswim platform to simulate, to train people, because it has a much better feature to illustrate or simulate a trade. But my main trading account is actually on Interactive Brokers. So I have two Interactive Brokers accounts, not just one. This is one. The other one is also equally big as this, right? And one of the things that I like about Interactive Brokers, and this is not about to, advising or recommending or advertising for them, okay? Recently, they pay me, everyone who has I think the net liquid more than $100,000. Any cash that you keep in your account, you earn like 4.5%, almost like as good as putting your money in the fixed deposit today. In Singapore, you have 5% US dollars. And then if you you buy bond, government bond, you can get also 5%, something like that. Now, if you put your cash there, you don't have to lock up the cash in a certain fixed term, but you still earn 4.5%, which I like about about Interactive Brokers. And TOS, they do not give you that much. Okay, so that's the reason why I park more money on Interactive Brokers than in Thinkorswim, right? And the way I trade, you normally see that I don't use up all my cash, right? In the strategies that most of the strategies I use, in fact, I sell options, right? I collect premium upfront. I have more cash than than buying. So in fact, the cash that I collect upfront, I also get paid 5% or 4.5%. So in this particular account, for example, if I go here, you can see that $500,000 value, and I'm still having like $200,000 cash. In the other account, which I also have almost like $500,000, I have $400,000 cash in there. Because it's the nature of the strategies that I use, I don't use a lot of cash. In fact, I collect cash upfront. So I get double, return. One on the strategy, the trade itself, the other one, Interactive Brokers pays me like 4.5%, which is another stream of income, right? So in this account, let me go to the account and account management home. Let's see if it works. Yes, indeed. So this is the same account, $500,000, up 130%. Yeah. So just show you that this how option can do for you, right? The second account, which is smaller account that I have in Thinkorswim. I have two accounts in Thinkorswim as well. The first account, this is purely dedicated for crouching bull spread, the one that I'm going to show you today. And this one has been doing fine, right? It's up 49% year to date, right? So I started at like $100,000 and profit and loss so far like almost $50,000. Yeah, so I up about 49%. Yeah. Another one, account number two, I also grew from 203 or 204 now to 200,000, 203,000. And so again, about 70K on this account, 52%. So on average, the two Thinkorswim account, I got like 50% return on investment year to date for like 6.5 months, right? And this account number two here, I use it more for, other types of trades and OTP trades. Mostly I use for OTP trade. And then I also use it for masterclass. Masterclass, I also have a monthly gathering live with my students where I go live on, do live trading in front of them. And that have been doing well as well. So that I also use the Thinkorswim account number two here, right? So I have another two accounts, which I could not share because it's Tasty Trade. I don't know how to show the P&L on Tasty Trade. The platform is not that friendly. That one also about 50% return on investment. And then last one is Thinkorswim, the big one, where I park a lot of cash there, earning 5%, while I'm doing some new strategies I'm still cooking. I don't want to reveal anything now, but in the pipeline, I have another 3 strategies that I'm still cooking. All right. So hopefully by the year end, when we do Black Friday or Black Market, for example, we could have a new strategy, hopefully. And next year have some more. Okay. So that's the way I work, right? I have now full time on options trading and creating strategy. So you will see more of those in the pipeline coming into the curriculums, right? And for me, my rule is I need, and whenever I test strategies, or I mean, to make it really work and proven that it fully tested throughout different market conditions, I need to do at least 9 months to 12 months. Okay, so I don't bring to you the half-baked kind of food, right? It has to be fully baked, really tested, successfully tested in different market conditions before I can introduce this to you, right? So then it will be safer. And with all criteria on entry rules, exit rules, taking profit, cutting loss, all those kinds of things, it will take time because I need to do it with real tests. In some cases, it could be hundreds of trades, before I can say it's safe to bring to our students. Okay, so that's how it works, right? So just stay tuned. There will be more in the pipeline. Now, this morning, Adam talked about the power of options, right? He talked about, okay, as an investor, you can use options to hedge the downside risks, right? The market has been doing very well, but who knows, in the next few months, it's a seasonality that this upcoming few months could be a bearish month, right? So then in those situations, what can you do? Can you hedge your portfolio? Yes, you know option, you can do it, right? How about you are sitting on a very large portfolio of stocks and some of them are doing nothing, just going sideways, like Disney, like, some of the stocks that not performing well. How can I get extra income, right? So this morning, Adam also talked about, you can do cover call, earning like 2% a month, 24% a year, which is extra income for you, which is good, right? And he also talked about you can sell cash secure put on fundamentally good stocks so that you could potentially own the shares of those stocks at a very good discount. Now, if you don't get to own it, you still pay, you get paid like 2% a month, like 24% a year. Still very good, right? So those are the things as investors you can do. Of course, traders, if you are more active like I am right now, you can use options to magnify your return on investment beyond 24%, right? Per year, right? So you can generate incomes from different market conditions, right? Now, the beautiful thing about option is if you have a smaller account, you can magnify it faster because it uses less capital per trade. Yeah. So if you know how to use option, you use less capital. And therefore that could boost your return on investment very significantly. Yeah. It magnifies your return, but not necessarily increasing your risk. Actually, in many strategies that we teach, the option strategy can help magnify returns with a lower risks, okay? Not increasing risk, okay? And then show you one example later on the crouching bone strategy. Okay? And finally, you can define the winning rate. I mean, the probability of winning for your trade before you enter the trade, right? If you use stock to trade up or down, technically you have 50-50 chance, right? But with option, you can predefine the winning rate or the probability of winning for your trade before you enter. So you don't have to settle for 50-50. You can define your rule and you play with your rule. All right. So the crouching bull I show you later on with the real money results. I show you my win rates on this strategy as well. Okay. Now, before I get into the crouching bull strategies, I want to make sure that some of you who are really new to option, right, know what I'm talking, right? Now, Adam has helped me tremendously this morning when he introduced the basic concept of call options, put options, sell, buy, those kinds of things. So it make my job easier, right? But I just want to refresh what he have taught you this morning, right? In case you forget, or for those of you who could not join this morning. So there are two types of options, right? Call options and put options. Okay, let's talk call option first. Because the strategies I'm going to teach you involve both call and put options. So you need to know both, right? And each of the option type you can buy, you can sell. So actually there's 4 different combinations, right? And the strategies that I'm going to teach you now will involve both buying and selling at the same time. But you sell 2 and you buy 1. So net, you are still the option seller. And I tell you, option seller has a much higher probability of winning. Right? This morning, Adam mentioned that you want to be selling insurance, not buying insurance, right? Because insurance company make money most of the time, right? All right, so let me talk first call option. All right, call option is a contract that allows the buyer of the call option to buy 100 shares at the strike price on or before an expiration date. And one example I use here is Google or Alphabet. This is my favorite stock, by the way. So if I want to look at the chart of Alphabet, all right, let me go to their Alphabet. The one I usually trade is GOGL, right, with the L. You can trade the one without L as well. So look at the chart. What do I see here? The chart looks bullish to me because you see the moving average are sloping up, right? The 50, 150, and 200 moving average are all sloping up. So clearly it's on uptrend. Yes, in 2022, it has declined significantly and it has bottomed and is now on the way to recover. And the recovery looks continue for some period of time. So for me, this is the reversal of the bearish trend. Right now, it comes to the bullish trend already. The trend is now up, very clear to me. And for me, one of the charting pattern that I like is this one. I don't know it's exactly like this, but it look like the cup, right? And handle. Yeah. Cup and handle is one of the very bullish pattern. Yeah, the cup and the handle. So this is a bullish pattern that I like. So technically, this is a good stuff. This is a good setup for a bullish strategy. So you want to buy a call option. Okay. Now, fundamentally, how the stocks, intrinsic value compared to the current price. Well, based on my evaluation, Alphabet intrinsic value or the fair value of the stock is about $153 per share. $153. Right now is at 125, right? So how many percent it is still below the intrinsic value divided by 153? It's still about 19% or 18%, call it 20%. So the stock price is still 20% below its fair value despite the recent rally. Yeah? Despite the recent rally, it's still below the intrinsic value by 20%, which is quite significant. So both technical and fundamentals setup are good. Okay, so I like to trade on the bullish side on this stock. And by the way, it is AI related. You remember yesterday you saw the summary from Adam on enabler, enhancer, and engagers. This is one of the big engager, right? So the big AI play here, right? We are in the sixth wave revolution right here, and we will see this stock have the tremendous potential upside. So if I like the stock fundamentally and technically as well, I want to buy a call option to benefit from stock going higher. So then one thing I can do is right now, the stock price is at 125, right? I can say, okay, so I like to buy a call option at 125 strike price, right at the money, but expiring in, let's say, 6 months so that the time decay won't be fast, right? So then I can go out to this is the Thinkorswim platform here, in case you don't know. It has very good feature for option trading, right? So you can go to the trade tab and open up the option change, right? Option change here. In option change here, you can go out to 187 days, which is about 6 months, right? 6 months from now. So that will be January 19, 2024, right? So you go open up that option series and you say, because I like the stock, right? I like to buy it right at the money, 125 strike price, and then I have to pay, right? Because I buy a call, this is a call option here, I will need to pay a premium for it. How much is the premium for this call option? Well, you look at the mark column here represents the market price, the value or the premium you need to pay if you want to buy a call option right here. So 125 call option, you will need to pay $11.80. And then one contract of stock is 100 shares, right? Equal to 100 shares. So if you want to buy this one, you will pay $1,180 for one call option contract. Got it so far with me? So you pay 1180 US dollars for one contract, 125 strike price, expiring in the next 6 months, right? So when you buy one call option contract like this, what do you expect? Well, you expect the stock price to go higher so that the call option value will increase, and then you can sell it at a better value, or you can convert or exercise the option into shares. So let's say in the future, if you think in the next 6 months, if you think the stock price will go up by, let's say, $20, so from 125 go to 145, well, guess what? You will be able to buy the share at $125 per share because you buy this call option. Yeah. So this call option allows you to buy the shares at $125 per share. All right. So let me go back to the lesson here. So the option information has the name of the stock, which is Google, in this case, Alphabet. It has expiration date, which is in this case, January 19, 2024. It has a strike price, the price at which you can buy the share at, which 125 in this case. And this is a call option that you want to buy, and then for which you have to pay a premium of 11.8 times 100, so $1,180 for a call option. All right. So now if you decide to buy it that way and you click into a ask here where you buy, you don't have to pay 12.2. Normally, this is a very high liquidity kind of option. You can get a mid price, which is the middle between the bid and the ask here. And if you just queue at 11.8, you will be filled. Yeah, 11.8, you you will be filled at 11.8. All right, now you analyze the trade before you execute it. Analyze the trade, yeah. All right, so here is a typical P&L chart of a call option, right? Along a call option, all right? So where's the break-even point? So here you can go to this and then set slices, break-even, right? So right now, the stop price is right here at 125, right? 125 right here. The break-even is 136.8. Where is that coming from? Well, if you buy the share at 125, and then you have to pay 11.8, right? 11.8. What do you have? So your break-even point would be 136.8. That is your break-even point. Sorry, 0.8. Yeah. So that is where your break-even point is, 136.8. What does it mean? It means that because you expecting the stock price to go higher, it has to go higher for you to make money, right? But it has to go much higher beyond the break-even point here before the expiration for you to make money, right? By expiration for you to make money. If it just goes to, let's say, from 135 to 130, wow, and then it stays there until the expiration, you would still be losing money. This is zero break-even point. So if you are here, that means you're losing some money, right? So it needs to go beyond that. It needs to go beyond 136.8 by the expiration for you to be profitable. That is the disadvantage of buying call option. That's why this morning Adam said, don't buy call option because you lose money most of the time, because the probability of winning is low, right? You need the price to go much higher beyond the break-even point for you to make money, right? Now, that's a disadvantage. And how probable it is, right? You look at this, the P&L chart here show you have only 20% chance of being profitable. This is 20% chance. You have almost 80% chance of losing money. This is a loss zone, yeah? So you see, when you buy a call option, the probability is not on your side, yeah? It's opposite. You will stay a very slim chance of being profitable, right? So that is a disadvantage. What is the advantage of doing this? Well, advantage is that you have potentially unlimited upside. There's no limit on the upside. Sky is the limit. The higher the share price goes, the higher your option value will be, and the more profitable it will be for your trade, right? That's a big, reward that lots of people want to do because they want to have a huge jackpot, right? And then the other one is you have limited downside, because if the stock price collapses, even if it goes to zero, the maximum loss is the premium you pay, which is $1,180. That's it. You cannot lose more than what you pay. So that's the benefit of buying a call option. You have limited downside, and the max risk or the max loss is predefined. You know exactly how much you could lose, and you cannot lose more than that, even if the stock price goes to zero. So that is the beauty of buying call option. Of course, you have higher probability of losing money. So the disadvantage and advantage right there for you to remember. Now, you look at the risk reward profile here. In this trade, I have limited downside and I have potentially unlimited upside. It sounds very exciting, correct? It sounds very good. But that is a trap. That's a mistake. Lots of people make this mistake, especially newbies, especially new traders. In fact, in my 18 years of trading options, the first 7 years, I've been doing buy call option like this most of the time. And I can tell you that I lost money most of the time as well. That comes from my own experience. Yet there was time when I make some good jackpot, right? I make some good jackpot on Facebook when it's almost bankrupt, right? It's when IPO dropped 40% or something, and my account is almost like blown out. So I left some money there. I put all the money in call options, and then suddenly it's a very speculative trade, and I thought my account was gone, right? But when the stock price recovered, the whole call option like exploded to the upside, and then my account like money, I don't know, many times higher than the original one. So I make multiple time profit in that particular trade, but very speculative. Normally it's like a jackpot, really. It's not like the real trade, right? That's a novice, it's not like professional trade, right? But I realized that when those guys of jackpot winning, it's just luck, pure luck. And it's not how professional trade, right? The other one I remember, I get a jackpot on Research in Motion, which is BlackBerry, which is a long story. I don't want to tell you, but a few times when I bought call option in the past and hit jackpot, but other than that, most of the time I lost money. All right, so if there's one advice to you as a newbie, don't buy call option. Okay, don't buy just call option. Okay, if you buy call option with the intent to sell another one, that's okay. But only buy a call option expecting the stock price to go higher. I tell you, in this case, 80% chance that you will be losing money. All right, so that's a call option here. Buy a call option. So the crouching bull strategies that I'm teaching have 3 legs. Leg number 1 is to buy a call option. So I just told you not to buy a call option, right? But I just want to make it clear, don't just buy a call option for the sake of buying a call option. That's it. That is a losing game. But if you buy a call option with the intent to sell other options, that is okay. In fact, that is a very intelligent way to trade options, right? We call it spread, right? That's why in the crouching bull spread, I have the spread. Spread means you trade more than just one leg. Often I trade like 2, 3, or 4 legs, right? Because spread is the way I can construct different direction trades for the trade, and it earns money while I'm waiting. So this is exactly how I'm doing. So, but the first leg of the trade is to buy a call option. Now, when you buy a call option, I repeat what I just said. If the stock price stays above the break-even point, yes, you will be starting making money. But the break-even point is very high up, right? So you need the stock price to move a lot for you to make money. Yeah. The call buyer, in this case, if I buy a call option, the call buyer has the right, but not the obligation to buy shares. If I don't like the shares, I buy 125. If the stock price drops to 120 or to 110, I don't have the obligation to buy the stock at 125. I just walk away and forfeit the call option, because I can buy at the market at a lower price. No? Yeah. So I have the right to buy at the strike price, but I don't have the obligation to do so. Yeah. Now, at the expiration, if the stock price stays below the strike price, well, I will lose the max loss, which is 1180 that I just mentioned. Yeah. So in this case, I lose 100,000 plus for one contract. I mentioned also the advantage. It has unlimited upside potential. It has limited downside in case the stock price collapses, which is good. But this disadvantage for me is more in this case. The disadvantage includes, number 1, the timely case works against the trade, because you pay the premium like you buy an insurance. Every day passes, nothing happened, you lose a portion of the money. You wake up, you lose some money, right? So time works against the trade, right? Buying a call option, especially at the money like this, is relatively expensive. Like you pay $11.8 for $125 stock, almost like you pay 8%. So the stock price has to move up by 8% in 6 months for you to just break even, right? So expensive. And it has a low probability of winning. So I shall show you the chart earlier. Buy a call option, in this case, you have only 20% chance of winning. Got it? Everyone's with me so far? Just have a check. Yeah, all right. So continue. Now, as I mentioned, when I buy a call option, I don't just buy a call option as a single trade, right? I will buy a call option with the intent to sell other options. So let's look at another call option, right? Same stock, in this case, Google or Alphabet. Same expiry date, which is 6 months from now in January 2024. But now in this case, I look at higher strikes because if I look at the higher strike price, the premium will be lower, right? Higher price for the call means the option is out of the money, right? Out of the money it means it will be cheaper. So go back here to the chart, the Alphabet here, call option, the strike price in the middle here. And if I move this one up, earlier we look at the 125. Now if I look at 140 call, which is, sorry, 120, maybe 125. So now if I look at the 120, 145, which is higher, let me clear this one also. Yeah, so now I look at 145, which is here. Yeah, so 145 call, which is out of the money, right, for the call side. The premium will be lower. Look at the mark column here. The premium is only $4.15. Earlier, if I look at 125 call, the premium is 11.8. If somebody wants to buy 145 call, he or she will pay less premium. Why? Because in that case, the stock price needs to go beyond 145 plus the 4.15 here to just break even. So the break even point for this trade will be close to 150, very high, right? So that's why the probability of winning, if you buy 145 call, the probability of winning it will be even lower. So that's why the premium is cheaper. So that is the second call option that I am looking at, right? So Google again, Jan 1924, 145 call, and the premium is 14.5. So I look at this option with the intent to sell. So not with the intent to buy, right? So right now, go back here. What I'm going to do is I will buy 125, which I talked about the first leg, right? I buy this one with the intent to sell this one. So I will sell this one. Imagine that this one, right? I'm the seller for of the 145 call. The one who buy it from me, 145 call there, will have a very little chance to win. Very little chance to win. Because the stock price will need to go beyond 145 plus $4.15. So 149.15, that is break-even point. Stock price has to go from 125 to 149.15 for that person to make money. So the probability of that will be even lower. Now, if you want to check it out, what is the real probability of winning in that trade for the person who buy this one? And for me, it's a seller, right? I will sell. I click into the big column here. I normally can sell at the mark price, here, $4.15, right in the middle. right? So I click to sell and I sell at 415. As a seller, I analyze the trade, right? So I now look at the red line, which is the selling part. So what is the break-even point as a seller I am right now? I have 95% chance of winning. See, if the stock price stay below the break-even point, which is 149.15 something, then I will win. I sell that call option, I will win. I have 95% chance of winning. The one who buys the option, 145 options, for me, would have about 5% chance of winning only. So I have 95% chance of winning. So when I sell option, I like this odd. I like a high probability of winning, right? Like when insurance company, when they sell insurance to you, like for those who ever buy insurance to protect your health, your car, your house, you can imagine the odds is with the insurance company. There's a very low chance that your car will be hit or you hit someone or your car or your house will be burned or flooded or whatever, or you have a terminal illness, right? So the chance, the odds is with the insurance company. That's why they make a lot of money, right? So in this case, I want to be an insurance seller. I have 95% chance of winning. The one who buy the 145 call is the insurance buyer, and he has only 5% chance of winning. In fact, I mean, it's very speculative trade, right? Because people doing this for those. So question, who are the one who buying this, right? I tell you, a lot of people want to buy this because they just don't know. As I did when I was younger at the early days of my trading, I thought this is a cheap, right? Cheap option, right? Cheap option, I just pay like $415 and I could potentially hit like few $1,000s. So the risk reward looks very attractive, right? That's why, okay, I mistakenly understood that this is a speculative trade. I mean, I thought this is a cheap way to trade, but it's the wrong way. I tell you, cheap doesn't mean it's a good trade. In this case, the odds is very low for you to win if you buy, right? But I'm the seller of the option, I will have very high probability of winning, right? So now I talk about two legs of the trade. One, buy at the money, 125 call. The other two is to sell out the money call, higher probability of collecting that money for free. And the intent of doing this is this. I tell you this. If you buy at the money call, you pay 11.8, right? Now, if you sell this one, you cut the cost by 1/3. So if you do both at the same time, you pay only about 7 point something, $8. So you cut the cost by 1/3. So that is called spread. Spread means you buy and sell. In this case, it's a vertical spread. And in the lesson, if you get into our curriculum, we call it bull call spread. Okay, buy a call at the lower strike price, sell a call at the higher strike price, right? Now, let me tell you the logic why I chose 145, right? Let me go to the option chain again, the January option chains. Why do I choose 145? 125 is clear because I add the money. Right now, stock price 125, right? But why 145? Well, there's a beauty, the beautiful feature that Thinkorswim has here. You see the plus minus $21 here. That is, they call it one standard deviation indicators, meaning based on the current option volatility, the market expect the stock price to move within plus or minus $21 per share from the current price, right? So 125 plus 21 or minus 21. That is a range that the market expect the stock price to move between now and January 2024. So that is the one standard deviation. So if you just sell a call option at one standard deviation point like this, so 125 plus 21, right? So it should be 146, but I just round it 145, okay? 146, 145 is okay. Yeah, so I chose 145 for that manner, right? If you sell 125, 145, you see one standard deviation strike price there, you have very high chance of not, collecting that money for free. The stock price won't go beyond that. Statistically, there's only 16% chance the stock price go beyond this one, 16% chance. Because within the plus minus one standard deviation, there's 68% chance the stock price will stay within that range. So 16 above, 16 below. So that's 100%, right? A little bit on the math, I don't want to confuse you. Sorry for bringing it up, but I tell you, if you sell 145, you have very good chance of collecting this money for free. So because I believe that the stock price won't go that much up by the expiration here, so I would sell 145. So if I buy this one, I expect the stock price to go higher, but not going beyond this. I will sell 145. So I buy this and sell 145. That is the spread. Yeah. So I do two legs together for you to see. Yeah. I buy 125. I hold a control key here in Thinkorswim and in Windows, and I sell 145. See, now I have two legs. I have vertical spread, which is the boon call spread we are talking here, expiring on the same time, 6 months from now, where I buy one call option contract at the strike price of 125, and I sell one option contract at the 145 contract strike price. And I pay a net debit of 765. So if you compare 765 here versus just buying a call option earlier at 11.8, you see you cut the cost down by 1/3, right? So now you pay only 2/3 of the cost. So that is one way for you to reduce the cost of the trade. Yeah, a little bit on advanced strategy here, but you just don't buy a call option. You buy with the intent to sell higher strike price, in this case, to reduce your loss, your cost, and that also reduce your max loss, and also reduce the time decay impact. So this trade, you will still have a negative time decay, meaning time decay still hurts the trade, right? But it will be less than just buying a call option because you buy and sell at the same time. So the net of the two will be less, right? Reduce the cost and also reduce the time decay impact. So let me show you the lesson here. So this one we talk, right? 145 call, and I sell it. So I sell a call option. So when I sell a call option, I will profit if the stock price stays below the break-even point. The break-even point for the Google trade, when I sell 145 call, is 145 plus $4.15. So 149.15, that is the break-even point if I sell the call option. Yeah, the call seller, as I am, has the obligation to sell the share at the strike price. Okay, so in this case, I do not own shares. So how do I sell, right? Well, imagine that if the stock price goes past the 149 or 150, my 125 call will, technically, I can exercise and convert into shares. And I use a share to sell at 145, right? So technically, I can buy the share at 125 and I sell one at 145. So I earn $20 spread minus whatever cost of the trade, which is $7.65. So I still net profit from that, right? So in that case, if I only sell a call option, I lose unlimited on the upside, right? So let me show you the chart here. If I only sell, yes, I have higher probability of winning. I have low probability of losing. But if I lose, I can lose maximum, right? I can lose unlimited loss. So don't sell naked call option like this, right? So another lesson, don't just buy a call option for the sake of buying a call option as a single trade, and don't sell a naked call option neither, right? If you don't own share, don't sell naked call. But if you do both, well, you see the chart looks different. Now, I click into both legs here, and you see the chart looks different, right? Both risks and rewards are predefined. So in this trade, I buy a call option at 125 call, and I sell an option at 145 call option, expiring the same date, right? I have the max loss of 765. Look at the number in the left lower corner here, 765, which is the net of the two here, $765 as a max loss. But if the subprice goes higher, I could potentially earn a profit. What is the profit? Look at this blue number, 1235. That is my max gain. Max gain 1235, max loss 765, almost like 1 to 2. Risk reward ratio, very good. So I lose less than I make, right? So that's a typical P&L profile of this, we call it bull call spread. Two legs together. Again, don't just buy a call and don't sell just naked call neither, right? You need to do both like this. It will reduce your cost and still have very good risk reward ratio, right? So that is two legs now. So, and that is called moon call spread. So in our curriculum, we call it moon call spread or the debit vertical spread. Yeah. It's a combination of two legs. Leg number one, buy a call option at 125, paying 11.8. And leg number two, sell 145, collecting $4.15. And hence, you pay a net debit of the two, which is 765 premium times 100. So you pay $765 per contract, right? Now, what is the advantage of doing both legs together? First of all, you lower the risk. You cut the cost by 1/3, right? When you cut the cost by 1/3, the capital will be lower, and hence you can increase your return on investment potential, right? Number two, because the cost is lower, your break-even point will be lower as well. You don't need the price to go much higher to break even. Now you need the price to move up, but not much to break even. And finally, as I mentioned, because you're buying and selling at the same time, your time decay impact will be minimized, okay? Disadvantage, of course, when you sell a higher call option, the profit is no longer unlimited. It will be capped at whatever 145 call that you sell, right? And you want to achieve the max profit that can only be achieved at the expiration, even if the stock price goes higher. Yeah. So the chart looks exactly what I just showed you on the platform. So that what we've done so far is the two legs, buy a call, sell a call, and they are all call option expiring on the same date. Now the crouching boot spread that I'm teaching now has the third leg also called put option, right? And the third leg, you also sell. So you buy one call, you sell one call, you sell one put. So you buy one and you sell two, net, you are still the net seller. And that is like you selling premium, okay? So put option, this one Adam has explained to you also. What is a put option? Is a contract that allows you to, the buyer of the put, the right to sell 100 shares at the strike price on or before the expiration date. So let me look at a put option on Alphabet. Now, when I look at the put option on Alphabet for the third leg, I don't look at the same strike. I don't look at the same expiration date, which is about 6 months. I normally sell a put option at about 1 month to expiration. So I don't have exact 1 month here. I have 33 days, right? So tomorrow when the market opens, it becomes 32 days, almost a month. Okay, let's call it a month. So when I sell the third leg, the put option there, it need to be about roughly about a month, ideally about 1 month. So question here is, okay, I chose the expiry date, but what strike price I would sell, right? So the general rule of thumb is the lower strike price you sell, the safer the trade will be. Because when you sell a put option, you are obligated to buy shares when it collapses below that strike price. So the lower strike price you sell, the safer it will be. Yeah. So it's like when you sell insurance to healthy people or the sick people, right? You see that you sell the health insurance or use different scenario. So driver, right? Driving, you sell car accident insurance to the one who have a very good track record on driving. It normally safer, right, than selling to the guy who have the very bad accident record, right? So the lower the strike price, the safer the risk, the trade will be. So in this case, typically I will pick about 1 standard deviation. And I look at this again, 1 standard deviation of this option series expiring in 33 days here is $10. So then 125 minus 10, what do you have? You have 115, right? So I will sell 115 put options. Okay, I would sell 115 put option. And the current market price of this option is $1.16, which is the middle between the bid and the ask here, right? Right in the middle, right? So if I sell a put option at the strike price of 115, expiring in a month, I would collect $1.16. Now, when I sell this put option, the risk is on the downside. If the stock price drops below 115 and stays there until expiration, I would have the obligation to buy the share at 115. In this case, I don't mind doing it. Why? Because Alphabet is a good stock. Right now at 125, it is selling at a discount versus intrinsic value. Remember, my intrinsic value for the stock is at 153. So at this price, I also like the stock already. But if I can buy the stock at $10 cheaper than this, like at 115, guess what? I'm more than happy to own the shares. Okay, so this morning, Adam talked about Warren Buffett selling, the put option on Coca-Cola. The same concept applies. All right. So this strategy, that's why this strategy, you need to use it on fundamentally good stock that is still selling below intrinsic value. And now you sell a put option below the current stock price. So mean you have extra margin of safety. You have super safe margin of safety here. If the stock price drops another 10 points, man, it's a steal. I don't mind doing it, especially it's a good AI stock, right? It's a big AI stock. I don't think the market has appreciated on the potential that Google can bring to the future for the AI revolution that they're developing. There are a lot of projects they're working on. They are actually, people talk a lot about ChatGPT and Microsoft investing $10 billion behind it and create a huge rally on Microsoft. But Google or Alphabet have been working on AI for many years. they have so many projects. They just like, they did not do a good job communicating what they've been doing and then why they've been leading AI study for many years. And I don't think the market has fully priced in on the thing that they could bring in the future. So I tell you, this is one of my favorite stocks for AI play. Okay, $125 per share. I already like it. If I have to own it at 115, oh man, I even love it, right? So no problem of selling $115, which is $10 extra margin. And by the way, the stock price needs to drop $10 in a month for me to own that one, right? So the probability of that is low. Now, let me tell you how low it is, right? So I just sell, and let's say I got a midpoint, 116, and I will analyze it. Now, I untick the other one. I just tick on selling Kasekyo put, which is a put option here. Now, if I just sell a put option expiring in a month, what is my break-even point? Well, the break-even point is 113.84. Where is it coming from? Well, it's 115 minus $1.16 now. So that's where I have a break-even point of 113 of 0.84. That's why the break-even point is 113.84. So in fact, if it drops below 115, I could still be profitable. Only if it drops below 113.84 and stays there until expiration, then I will be losing money in this trade. But in this case, I will own the share at the 115 minus $1.16. So I own the shares at 113.84, which is much cheaper than today, which I love to do, right? So the probability of me getting this $116 for free is 82%. Very high probability of winning in this trade. All right, so very low chance that the stock price will drop below that by the expiration. All right, so that's the benefit of selling the Kasekyo put. So the third leg here is to sell a put option. And what is the benefit of selling put option? You earn the premiums, which is 116, right? If the stock price stays above the put strike price at the expiration, you will be obligated to buy 100 shares if the stock price stays below the strike price, right? So below the 115 at the expiration, you need to own. You mean if you can delay or buying it, well, in the lesson I will teach you on how to delay. But if you want to delay, then you need to buy the shares. Buy the share, then you need to have cash to buy the share. So in this case, you buy the share at 115 minus $1.16 you collect. So your cost of owning the shares is 113.84, right? So you need to have like $11,384 to own 100 shares. Yeah. The advantage of this selling Kasekyo put, the put like that, is it has very high probability of winning. So I showed you earlier, right? It has very high winning probability, like you sell insurance, right? So you want to be an insurance seller, right? You don't want to be an insurance buyer. Be the seller, not the buyer. I tell you, the first 7 years, I was a buyer most of the time. I lost money most of the time. After that, I learned proper option trading, and I realized that sellers are the ones who make most money most of the time. So I became the seller since then, right? And I just love it. So in the theme today, we also say you should be the dealer, not the player, right? The dealer, not the player, or the seller, not the buyer, right? Because you are selling option premium, time decay works in your favor. And what is the downside, yeah, you could potentially own the share at the large discount, right? In this case, if the stock price drops so much, I own the share at 113.84, which is much cheaper than the current stock price, 125, and significantly cheaper than the intrinsic value of the stock, 153. So see the logic, right? Apply on fundamentally good stock being trading at a discount versus intrinsic value, and then you sell a put even below that. So you have extra margin of safety. Yeah. The disadvantage is there if the stock price fully collapse, right? Totally collapses, and you have no downside protection. But it's okay. If you do on a good stock, eventually it will recover. Yeah, no issue with that. And I will show you one example, or maybe more than one example, where I've been sitting on the stock for a long period of time. The stock price goes nowhere, and still making good money on it until recently it started to rally and it make a lot more money, right? All right, so here, the strategy, crouching bull spread. Crouching bull spread involves 3 legs, okay? But first of all, on the checklist, it has to be used on fundamental legal stocks like Google, Alphabet that I'm talking about. And the stock price needs to be trading below its intrinsic value, okay? It has 3 legs. Leg number 1, buy a call option at the money, like the Google that I'm talking about, 125 call at the money, right? At the money is the current stock price, right? 125. Expiry in 6 to 9 months, or if you want more time, 1 month, 1 year is fine, right? 9 months, 1 year is okay. 6 to 1 year, 6 months to 12 months is fine. So once you have the long call, then you sell a higher call. You sell a higher call at the target price. Target price, if you don't know where its target price is, you just choose one standard deviation. Yeah. So in this case, it's $20 up, right? 125, and $20 higher is 145. And your break-even point is like 149, even higher. Yeah. And then the third leg is you sell a lower strike put at about 1 standard deviation at the lower strike, expiring in about a month. So the first 2 have the same expiration, which is 6 to 12 months. The third one would have about 1 month expiry. And the intent of the third leg having a 1 month expiry is because you want to keep rolling the cash secure put, buying time for the trade to play out. Sometimes the stock price goes sideways for like 6 months, right? So you need to buy time for the stock price to rally. And during that time, you keep rolling your put option so that you collect more premium, and time decay works in your favor. So essentially, when you do 3 legs here, you execute a trade with a bull call spread and a cash secure put. Yeah, the bull call spread has a long dated expiry, right? And the cash secure put has a short dated expiry. And then, as I said, you keep rolling the cash secure put upon its expiry to collect more premium, buying more time for the trade to play out. Right. So in this case, before I get into further, I show you the full trade here. So we examine the buying a call. Yeah, buying call is like this. And then buy a call and sell another call. This is a bull call, looks like this. And the third leg will be crouching bull. The crouching bull looks like this. Looks like this curve and then like this. Always like this, right? So currently the stock price is here. There's some break-even point below that, some extra margin of safety. And then this is a short put strike. The short put strike will be here, right? So until the stock price drops to the short put strike, you don't see the trade losing much money, even if it dropped quite significant, right? Only if it dropped below the short put strike, then you see the loss accelerate. But on the bull side, you see you have a tremendous upside, right? Tremendous upside. And in this case, you typically have a good probability of winning. So if you move the break-even point to here, you have like about 57, 58% chance of winning. If you say this is the one I can accept the loss, meaning the short put strike, you have almost like 80% chance on the high profit zone, right? Here you have a small loss, but the one that have the significant loss will be in the 20% zone, right? So that's what I like about the trade. Now, if the stock price stay exactly where it is right now, which is here 125, what you see here, you see that theta is a Greek. It measures the time decay per day. So this trade with one contract like this, every day passes, it brings you $3.61. Call it $4. So you wake up in the morning, you get paid $4. Earn $4 a time, $4 a time, and the $4 will accelerate, not just at $4 here. So towards the expiry date of the put option, you see the theta decay accelerate, right? So let me simulate it for you to see. Today is the 16th of July, right? Tomorrow is 6, it goes up, right? See, the theta will accelerate. So the time decay will be higher, or I mean, until it, a certain point. But the point here is the trade should have a positive theta, meaning I don't mind waiting long time. It's okay. As long as it takes 6 months, 9 months, it doesn't matter because I am paid to wait. So unlike you invest in stock, if you invest in a certain stock and the stock price goes sideways, you are sitting on dead money. Here is not dead money. It's productive money, right? Every single day, it generates some money for you. So that's why I started this strategy last year, 2022. Remember 2022, the market was very bearish, right? I started testing it in last year, and early last year, actually starting, I think in February 2022, which is at the peak of the market, and the market went down from there, right? And how did it perform? Let me show you this slide. Why crouching bull spread? This strategy was born and survived in the bear market 2022. So if this strategy was proven profitable in the bear market, I can tell you in the bull market, it will fly. Yeah. So it was born last year. I tested it at the early of 2022. And by, I think in November, in the black market event, I introduced it to you, right? And that at that point in time, I did only like 15 trades and making like $12,000. So like $800 a trade kind of thing. Still very, very low level of testing. But because it was proven profitable in the bear market, I scaled it up in 2023. And it did very well. Okay, so last year, first of all, this is a bullish market. You can see the curve, right? The trade will make money when the stock price goes higher. So it's a bullish market. It's a bullish trade, right? So it's a bullish trade, but last year it was in the bear market. So the bull will have to defend first. And then we wait for the right time to attack, right? So when they say the bull needs to defend first, what does it mean? It means that the bull have to accept that it will take long time for the rally to happen. And when it's defending, it's not losing ground. And in fact, you are paid to wait, right? You are paid to wait. Time decay works in the trade favor. So every day you wake up, you make money. So that is defending, right? You're not making tons of money, but it makes money. Yeah, as long as the price is not like totally collapse, right? Because you're doing on a good stock anyway. And you wait for the right time to attack. And I tell you, that right time is now, this year, right? The technical setup has to be, when you use it on a good stock, one thing, but the technical setup has to be the stock chart looks like it has bottom or is bottoming. At least it's stop declining, then it's okay. Yeah. As long as you look at the chart and you see that it's already bottom and on the way to recover, or not yet, but at least it has stopped declining. That's fine. You can enter it. And I tell you, 2023, this is where I see crouching bull trades thriving, has been thriving in this year when the bull market returns like this year. It really went through bad time, now good time. And bad time, it make money. In good time, it make even more money. All right, I will show you my summary, the summary of my CBS trade later on. Just a very quick summary of how to construct a CBS trade. Has to use on fundamentally good stock, the stock that you don't mind owning, like Google. I don't mind owning Google even here, even at the current price, $125. Why? Not only Google is a big AI play, but I myself has been using Google for many years and every single day. I tell you, I cannot imagine without Google, I could do a lot, right? So I could not do a lot without Google. So basically, I'm watching YouTube and I use Google search every single day. I learned a lot from YouTube itself. I watch tennis summary on YouTube and lots of channels, lots of learning lessons in there in the YouTube. So I love Google for that matter, right? And I try different Google other search like Bing and stuff. I tell you, Google search is still the best. I tell you that, my own experience. It gives you exactly what I'm looking for. When I type Wimbledon 2023, it knows what I'm going to look at, what exactly information I'm looking at, right? The timing of the play, of the match and stuff like that. When I use Bing, I say Wimbledon 2023, give me a list of garbage thing, you know. It's still not the one that I want to do. I don't know. I feel that Google search has a much better algorithm. It understands me better myself. So I love the company for that matter, and also because it's a big AI play, right? And fundamentally, it is still a good. It's still very cheap at the current price, and it's selling at like below intrinsic value. Technically, as I mentioned, the cup and handle, I like that technical setup as well. It has stopped declining. It's on the way up. It cup and handle, it's bullish setup. And the way I construct the trade would be buy a call near at the money, sell a call at 1 SD, 1 standard deviation strike, and sell a put at 1 SD at the lowest strike, right? About 10 to 11% below the current stock price, and hence create more margin of safety. Right? So key benefit of the couching bull, if the stock price rallies, man, I tell you, the trade will have a significant upside. Yeah, because it have boom call spread. This is the one that have a higher upside, right? If you just sell a classical put without a bull call, when the stock price rallies, you get very little money, right? The 2% a month kind of thing. But with the boom call, you dry on the upside of the trade. So stock price rally is the best scenario. If the stock price goes sideways, man, that's the rule of the classical put. Yeah, classical put will function very well if the stock price goes nowhere. You keep earning 2% a month, 2% a month, right? Time decay works in the trade favor. If the stock price stays below the put strike price, I tell you, this is one of the not so good scenario. The stock price drops, right? You could roll the classical put to the next month for a credit, and ideally you roll it lower, creating more margin of safety. Now, among my trade, there are a few stocks that have been in this situation. Disney is one of them. I'm doing crouching on Disney, and Disney stock keep going down, right? So I kept rolling it down, creating more margin of safety, right? And when you roll the CASIQ put lower, meaning you reduce the potential buying price of the share, right? And you just buy time for the stock price to recover. So in this trade, you will win 3 out of the 4. You will win in 3 of the 4 scenarios, pricing scenario. If the stock price goes up, definitely you win. Stock price goes sideways, you win. And stock price goes slightly down, you also win. The only one scenario where you lose on a trade is a stock price drops significantly, like Disney, for example. I'm losing money on Disney. I think one of the very few CBS trade that I've been losing money, okay? Watch out though, trader, you need to have cash ready to own the stocks in case the share keep going down, right? So, well, it is rare, but it could happen. So don't like overtrade it. You need to make sure that you can afford it. Don't trade more than you can afford, okay? The trade itself, because you sell CASIQ put, there will be no downside protection. So in a scenario when the whole market collapses significantly, like COVID crash or something like that, right? Those shares could go through a significant loss as well. It's exactly like you holding shares. It better because you have a margin of safety, but at a certain extent, it can only protect you for like 7 to 10% on the downside. Beyond that, if the stock price drop like 40, 50%, you will still incur a significant loss, right? So be careful on that. Do not overtrade CBS. Only trade what you can afford. When you enter the trade, the broker block just a nominal buying power or capital, but keep in mind that this buying power is not fixed. It will go higher if the stock price keeps declining, right? So keep in mind on that. When to exit the CBS? Well, I have exited about half of my CBS. So on the CBS trade, I trade so far, I closed at 47% of them, like almost half of them. And most of the time when I exited it, either the stock price goes much higher than the short call. I mean, hit my target, I make like 100% profit, I exit it, right? That's most of the time I did it. Very exceptionally rare case, I cut loss because the stock price has turned, the fundamental of the stock has turned very negative, deteriorated. I felt that the stock price fundamental have changed completely, right? I think there's only one case or 2 cases I cut loss, and I don't want to trade it anymore. The other one is like the stock price is still okay. I still managed to break even or make some money, but the premium on the put side becomes so little. So it's not worth rolling it anymore. So I close the trade, release the capital for new trades. Most of the time I exited the trade because it hit my profit target. So here's, okay, before I show you my CBS trade result, can I have like 2 minutes break? I need a bio break, some water, management, and I come back. All right, so give me 2 minutes break, and I come back in 2 minutes. I show you my trade result. Okay. All right, welcome back, everyone. I hope you can hear me. Everyone can hear me and see me. Give me a signal. Yep. Thank you, KH. Thank you. Oh, good. All right, so let's continue. So here is the summary of my CBS trades so far as of last Friday. So I show you the trades that I did in 3 of my 5 accounts. So I have 5 accounts in total, right? 2 in Thinkorswim, 2 in IB, and then 1 in Tasty Trade. So I mostly trade in these 3 accounts, but of course the other Thinkorswim account, I also trade CBS. Numbers not here because I just did not have a, maybe I need to trace back. But I tell you, among the 3 accounts where I trade CBS, what do I do? So far I have done 200 trades, CBS trades. And that does not include the one in another Thinkorswim account where I use for OTP trades and masterclass trades. So the CPS trade in masterclass and OTP has been doing well as well, but it's not included in here. Okay, but in future maybe I should include that. Okay, so in these 3 accounts I've done 200 trades. I have closed almost half of them. And among the 200 trades, both open and closed, 83% are profitable. 83% are profitable. 17% are losing money or have lost money. Okay, depends if it's closed or it's still open. Okay, so win rate is very high, 83%. So this morning, Adam showed you one statistic, right? I think from Investopia, 82.6% of people buying option lost money. Because in this case, I'm the sellers, I have 83% chance of winning. So in fact, it's very consistent with that stat, right? 83% of my CBS rate has been winning. Right, so that insight number 1. So 3 accounts here. The main account of $500,000 account I showed you earlier, I did most of my CBS trades on that account, right? 110 trade. The other fully dedicated TOS account, I did 41. This one actually I started last year in the bear market, but because it's smaller account, so I did less trades there. And the another IB account I did 49. Okay, the last account, the number 2 here, I use it for new strategies. I'm testing new strategies, and so I do not trade a lot of CBS trade on that, but only 49 trades so far. Okay. Now, next one, in these 3 accounts, over 200 trades, I have generated $277,000 profit for this one CBS strategy. One strategy, $277,000, 3 accounts combined. Okay. The average profit per trade, 1,386. So on average, I make about $1,400. Of course, that's the average between losing and winning trades. On the winning trade, per trade, I made about 2,000. And on the losing trade, I also lost about 2,000. Okay, almost the same. Win and lose per trade is almost the same. The only thing difference is I have a lot winning trade than losing trade. And that makes a difference. That is $277,000 here. All right. If you divide it by 200 trades, the capital that I use is $1 million, $1,065,065. That translates into about 26% return on investment, right? 26% return on investment. Now, the thing here is I don't need to tie up $1 million capital in this trade for many months, right? In fact, my time in trade, my time in the CBS trade on average has been 81 days per trade. So per trade, I've been in the trade by like 81 days per trade. So imagine that this is a cumulative capital over, let's say, because some of them I started last year, let's say on average, I like 9 months, for example, 9 months in total, or 8 months in total. Over 8 months, $1 million have been used, but recycled every 81 days. So 81 days is almost like less than 3 months, right? So imagine that every 3 months I recycle the capital. So this is a cumulative capital, $1 million. You need to divide it by 3, right? 9 months, right? So you can say that it's not bad, okay? 26% return on investment per trade, and each trade is like less than 3 months. So you can get like 26% return on investment per 3 months. It's pretty good, right? Imagine if you just sell cash secure put, you get 2% a month, right? So like 3 months, you get a 6%. Here you have 26%. Yeah, including losing trades, everything inside there, right? 26% for 3 months per 81 days. Yeah. And so far, the CBS trade contributed a large part of my year-to-date results. So I showed you earlier my accounts doing well, and a large part of that has been behind the CBS trades. Now, I mentioned that it does not include CBS trades that I did for my masterclass students and my OTP members, right? So those are also doing well. So I add on those on top, it could be easily $300,000 plus from one strategy. Yeah, so today I taught only one strategy, CBSR, but in our curriculum, we have something like 20 strategies, both level 1 and level 2 combined, right? So there's a lot more in the curriculum you can learn. So just I hope give you a flavor of what option can do, and you can use it to magnify your wealth and get you to the financial freedom faster. Now, among those trades, let me open my playbook here. I will zoom into a few biggest winning CBS trades that I did, right? So let me open it. Let me see. I do have the Excel trackers, right? Tracker where I have a lot of trades, but these are the account I'm talking, the $500,000 account where I do the most of the CBS trades here. So look at the trade, you see the one in red are the one that lost money. The one in black is the one that's winning, right? So you see that there's only few losing trade. The most are the one that making money here. Okay, and then I have another same account. I'm testing the crouching bull, but for earnings play. This one I haven't introduced yet. Still on the testing, but also doing well, right? So also generating like 35,000 so far. So a lot more on my pipeline. Okay, so just be patient. I still have a lot more to introduce. But so far, look at the trades that I have done, right? The one that give me the best is Google Trade. Yeah, Google Trade has generated like almost like $48,000 for one trade. Now that's the biggest, so far it's the biggest, most profitable trade that I have so far. So we'll look into that. And then another one that I have here, Meta, 5 contracts. So Google, the reason why I make the most profit because I trade a big size. I trade like 20 contracts. The biggest, right? So far, you see, most of the time I trade like 3 contracts, 2 contracts, or 5 contracts, or even 1 contract. This one I trade 20 contracts because I like this so much. So I overexposed on this trade. So I traded 20 contracts. Another one that did well was Meta, where I've been trading 5 contracts. This one's still open. It made $27,000. Amazon is not bad, 10 contracts, $26,000. So these are the big one. So you can say part of the magnificent 7 AI stock, Amazon, Google, Meta, and even Microsoft. Microsoft's not so bad. Microsoft is like $13,000, 3 contracts, right? So the top 4 there, Google, Amazon, Meta, and Microsoft. Those making like more than $100,000 for me, right? So let's zoom into Google, right? The biggest one. Review. All right, so double click into this. Double click into this and you will see my trade. Here, Google. The one in red here. Let me change the color so that you can see it clearer. Let me change it to, let's say, yellow. Okay. So Google trade here. And I need to show you the the heading so that you know what columns I'm talking. You see, I have so many trades there. I see 5,000 rows, 5 accounts. I have like hundreds of trades that I need to manage every day. All right, so this one, yeah, let me freeze the free hands here. Okay, okay, let me show you the Google trade. Here we go. All right, so Google trade, let me move here. I made so far still open about $48,000. Yeah, 20 contracts, right? 20 contract. So 48,000 is a P&L since I opened. Now, if you want to know how much of that is from the cash secure put itself and how much of that is from the bull call spread, I have the detail here for you. The bull call spread is these 2 legs, right? But sorry, go back to the date when I enter the trade first. Okay, go back to the date when I enter the trade. That's one I missed earlier. So Google trade, I entered on 13th of Feb 2023. Less than 6 months ago. Less than 6 months ago. Got it 5 months ago. Yeah. Microsoft, I enter in March, early March, also less than 5 months. Meta, I entered late March. And that's 4 months ago. And then for Amazon, I enter in early Feb. So Google and Amazon, I enter almost the same time, right? So at that point in time, the share price was at about, at the money at that point in time at 95, right? Because I sell 95. So the way for you to remember the date when the price when I enter, because in the buy call leg, I buy at the money, right? So at that point in time, Google share price at 95. So I bought 95, I sell 1 standard deviation, which is 25 points above. So I sold 120 calls, right? At that point in time, I sold almost like a year expiration. Now it still have 6 months to go. Yeah, or not, yeah. And then the cash coupon is this leg. I kept rolling it. Now the bull call, these 2 legs have generated $20,000. So out of the 48, 20 is from the bull call, and 28 is from cash secure put. Yeah. So cash secure put, I have rolled so many rounds here. Normally I just roll every month, right? But this is my main trading account. I roll it very actively. I roll it almost every week or every 2 weeks. So I collect more premium. It just requires more efforts though, right? So this one plus the cash secure put that's still open here, 2 combined, it's $28,000. So more than half of the profit comes from the cash secure put, about 60% of that, and then 40% of the profit comes from the bull call spread. And the reason why the cash secure put generated so much money because Google share price only rallied recently. Remember when Microsoft rallies first,
because behind the ChatGPT and the whole thing hype up, Google actually declined because people thought that Microsoft gains is Google loss. That's why during that first period of time, Microsoft price went up heavily, right? But Google share price was underperforming. So it spent the first few months on the sideline or even declining. That's where I rolled the Casicule put multiple rounds. That's why I collected a lot more money from the Casicule put. Only recently, Google started to rally, right? You see here, if I show you on the daily chart, I entered the trade in early Feb, right? Early Feb here. See, since I entered the trade early Feb here at 95, somewhere here, the stock price even dropped when the whole thing was hyped up because of ChatGPT thing. And then it rally, but then it goes sideways, pretty much flat or slightly up. But only recently, stock price has started to go up, retrace, and now last week it went up quite strongly. So that's where the bull corn started to make good money. This is where the Casicule put make money. Yeah. So that's why the trade have two parts, right? Casicule put gives you the profit when the market goes sideways, right? And the bull corn makes a lot more money when the share price goes up. Yeah. So that is the biggest profitable trade for me on Google. Amazon make $26,000 for 10 contracts here. And then how much is that from the bull corn? 12,000 from the bull corn, and then 12,000, and then 14,000 for the Casicule put. Pretty good, right? Casicule put also contributed more than half of the profit, right? And I think Microsoft the other way around. Microsoft make more on bull corn, if I remember correctly. So Microsoft, I make $13,000, and then almost $8,000, which is 65% of the profit, comes from the bull corn because the stock price went up very fast. Similarly, for Meta, also the stock price went up very steadily, right? So the trade make about $27,000, and this one makes 16 out of 27, right? 16 divided by 27. Of 60% of the profit comes from the bull corn. Yeah. So just give you a quick sense where's the profits coming from. On average, half of the profit comes from Casicule put and half comes from the bull corn. But if the stock price goes up very fast, you see bull corn makes more money. If the stock price takes some time to consolidate, go sideways, you see more profit comes from the Casicule put. So the trade will benefit from different market conditions. Sideways, slightly declines, fine, or goes up, even better, right? So just a little bit on, zoom into my some of the CBS trades. Of course, I have losing trade on like Disney and stuff like that as well, because the stock price has not recovered yet. All right, so very quick on some of the testimonials here. Our student also did very well, and they wrote in, some of the testimonials. This is from Tony. So Tony say, you have given me the tool to change my life. I have nickname for Mr. Bang. So he called me Pham Bam Bam because he's a Superman option trader and coach. I'm 72 and have more than double my account in 8 months, something I only dream of, okay? This Jason from the US, Jason said, I think this, if I remember correctly, it was last year when the whole market like on a sell-off, and he say, my option cost really paid off today, best single day, can profit ever. Yeah, lost 2,000 long-term portfolio, which is investment portfolio. However, I make more than 10K in option trading today, right? So when the market goes down, right, You could lose on the investment portfolio, but you could make money from trading options. That's what Jason did. Right? This is from Michael. Michael say, me too. I discovered Adam on YouTube, and I knew I had to have him as my mentor when I saw his videos. Bought on the courses last year, finally completed watching swing trading's investment option forex. All my knowledge came from Adam and Bang, even though the market is going down. This is last year. My account is about staying the same because of hedging, right? I'm not worried about the market falling when I'm sitting. So you can use option to hedge your downside risk, right? If you like sitting on a portfolio of stocks. Hannah, I have profit every week, need some losses to feel it. It is too good to be true. Yeah, so that's what Hannah said. All right, so this one, Adam talked a lot about the curriculum's contents that we are offering you. Just a quick summary of this program, right? So Adam and me have jointly developed. We put a lot of effort and we put a lot of hours of examples with the intent to help traders to really go through from the beginning to executing, correcting, adjusting the trade to closing the trade, right? From end to end, okay? And really a lot of passion that we have put into it. And that is not the end, right? We continue to test new strategy, new learnings, and then we'll keep adding to the curriculum. That's why you see we have more lessons being added to the curriculum. So, okay. So trading option level 1, Iron Shell, it basically equip you with the basic knowledge on option world, right? On about option fundamentals, right? This is a very important part, the foundational part, right? If you don't know this, forget about strategies. You need to learn from the basics. When I came to an option training class about 11 years ago, I was thinking that I knew a lot, right? So because I have like 7 years of option trading before that. But I realized that I did not know a lot, okay? So I need to unlearn and relearn the whole thing. So don't think that you already know everything, right? You can always learn new things when you listen to the lesson again. So we keep the video very live and you can watch at your pace. It's an on-demand course, right? So just a summary of what Adam taught this morning. It has 11 lessons in total. So lesson number 1, on about option basics, right? Number 2, how to set up the trading platform, the tools, the charts, Number 3, understand call option, put option, long, buy call, buy put, right? Number 4, how to generate extra income from your existing stocks investment portfolio, right? Cover call. Number 5 is what if the market goes through the retracement period, right? Big sell-off. How do you hedge your portfolio? Right. Lesson 6 about cash secure put. So I don't want to talk that this morning. Adam already talked. I also just mentioned one leg of the crouching bull is about sell cash secure put. Right. Lesson 7, buy a vertical call spread, which is boom call. I just covered it as well. Number 8, how to buy a vertical put spread to bet on the downside. Number 9, cash flow wheel, how to generate money converting from cash to cash secure put to shares, cover call, and go back to cash. It's a very beautiful cash flow wheel that you learn there. 2 bonuses, basics of technical analysis, and also your trading station, right? So beyond the level 1, and if you cover that level 1, which is a basic foundational part, you need to learn on the high powerful weapons, which is the 15 profitable strategies that we put out there, and many of which are my own proprietary. I created it and I trademarked it and it's there part of you. You cannot find it elsewhere. Okay, only here in this course you will find it. Iron Striker. Okay. Now, Iron Strikers also we start with the introduction on the advanced option call. Now we talk more on the selling part. On the level one is more on the buying. On level two, you change the game. You become the dealer. You become the seller of the option. You become the option insurance company, right? You sell option collecting premium. You have high probability of winning. The odds is in your side. The time is in your side. Time decay works in your trade favor. All right. So we have credit spread. So this morning, Adam covered bull put spread. But again, he talked conceptually. There's a lot more for you to learn. We just touched the surface of the whole thing, right? So we talk about bull put spread. We talk about bear con spread and iron condor for you to take advantage of the market going sideways. You know, you win in many market directions. Earning probability spread, some of you could be very itchy, you want to play earnings. Yeah, we designed a couple of earnings strategies for you to play. So one of which is earning probability spread. The other one is earning sniper spread, okay? Lesson 5 is long diagonal spread. This is one of my favorite strategies that I use a lot. It's like a proxy for investment. So if you want to invest in a certain stock, but you don't have a big account, right? How can you buy a lot of stock like Amazon, Microsoft, Meta, right? You can buy a few shares, but what if you have a higher exposure? You want to have a higher exposure. You want to magnify your return. Then long diagonal spread could be the one for you to use. It mimic like you buy shares and sell cover call. But in this case, you use only a fraction of the capital. Yeah. So we call it poor man's cover call for that reason. So you can still do cover call, but you don't need to buy 100 shares. Yeah. You just buy a call option and you sell another call option. And it's cheaper and it boosts your return on investment. Yeah. Long candle spread, what if some of the stock price or ETF price keep going sideways? You can take advantage of that by using the long candle spread. Synthetic long or short is another way for you to invest using a fraction of the capital, right? So synthetic long is like buying share, exactly P&L, exactly like you buying share, but you use it like 1/4 or 1/5 of the capital. Yeah. Protective bullish synthetic, or now people call it boom bar. I trademarked that because it's a strategy I created. I think 4 years ago, it's been doing fine. Sniper is a big one that I created in late 2019 and did very well, generated a lot of money. I'll show you some of the testimonials later, but it's one of my bread and butter strategies I'm doing every single week, right? This year, Sniper is also doing very well. We would teach you also on how to manage from the psychological and risk management standpoint, how to build a portfolio using options, right? And because we have some like 20 strategies, you need to know when to use each strategy, right? Now, let me pause right here. Some people ask me, okay, Mark, what is the difference between Adam's investment cost, Alston's pham, right? Money, price manipulation actions, and option? What are the differences among those three? Here's how you should understand it. If someone says, I can, what should I learn first? Okay. For me, the way I see the three comes together, right? Three courses come together. Adam investment course is like identify the target. Identify what. So the investment tells you or teach you how to identify good company, the top 1%, how to value it, how to know it's a good company or bad company, lousy company, or the one that you don't mind owning, right? So investment class tell you or teach you how to identify good stock, or to answer the question of what. Yeah. pham, I mean price action manipulation, basically answer the question of where. Okay, so you know the target, but okay, so what company or what enemies, whose enemies, and is they strong or not, right? But where? Where's the enemy? Okay, so where's the enemy is moving? Enemy is moving this way or that way, up or down, or far away or near your place. You don't know. So the price action manipulation tells you where, how far the enemy is. Okay, so not just identify the target, but know where the target is going or moving. And finally, option equip you with all kinds of weapons. All kinds of weapons for you to use depend on the target, how far the target is, where the target is moving to. You will use the appropriate weapons to attack, to strike, right? It has everything. It has like grenade launcher, snipers, everything, all kinds of weapons that we can equip you, so that the moment you identify the target, you know where are they? Are they far or they near or they moving in a certain direction? You will pick up the right weapon to attack. That's how I see on things together. Ideally, you should know all three. I tell you that. Knowing what, knowing where, and knowing how. Knowing how to attack, how to make money. Those are the ones that complement each other very well. All right. So know when to use strategy is like know what weapon you should use to attack a certain target or enemy. If it's too far, you need some launcher, right? If it's like the target is too small, you need a sniper, something like that, right? So you need to use the right strategy, depends on what and depends on where you think the price will move to, right? And then we keep adding new strategies to the curriculum, right? Break ratio spread, earning sniper spread, or this one I created as well, put extreme, and then sniper 4B, Snipex 4B. Okay? So Snipex were created 4 years ago, but then I realized that some of the traders who have smaller accounts, they want to test it out. So I created Snipex 4B for those who have smaller accounts, who just started out, right? It costs very little, right? And I tell you, this strategy is doing well. So like Hannah telling us that first 4 weeks trading Snipex, she make, I don't know, good money there, right? Stellar results using trademark Snipex strategy. This is from Bagus. He also shared his trading summary, and 56% of the profit came from Snipex. David got 35% profit from first full month with Snipex. Okay, so I tell you, those are the very powerful weapons that we created, right? Continue, because it has not ended yet. You continue to add new strategy into it. So color is the one that you can still use. So color is very interesting strategies that I watched one of the movies, and I saw people use that, and I see the benefit of that strategy. So I added. So basically, you want to protect your portfolio downside risk for free. There's a way for you to do it. So caller tell you how you can protect your downside risk for free. Yeah. Boombank collar strategies is a new strategy, not new, 2 years already, 2.5 years already. Also, I created it, right? How to repair the boombank collar trade which goes wrong, right? 3 ways converting in different kinds of trade. Very detailed full videos on how to do that. And this one, lesson 20. This is one of the hot topic that most of students, especially new one, very worried about option assignment, right? Oh my God, I'm now deep in the money. Will I be assigned? What do I do if I don't have money? how it's going to play out, right? So I created these videos. I mean, I think 4 or 5 videos. I will answer. I answer all kinds of scenarios, assignment scenarios. A lot of people wrote to me and say they are so relaxed after watching my videos. It answers every single thing about assignment. In fact, I mean, when I ask them, should you be worried or should you be happy being assigned? The answer is, in most cases, you should be very happy if you are assigned. And you watch the video, you understand why. In fact, in one of my accidents, when I got assigned on one of the stock unexpectedly, and I lost like something like $40,000. And I managed to turn it around, and eventually I converted into a big winner. I make like something 20, I think 75, 7 or 75, I think $7 or $75,000 from losing $40,000. Turn around completely because I know how to manage the assignment. Yeah. So this is something you must watch. I tell you, it will clear up all the concern about assignments. Yeah. Rolling. This morning, somebody asked Adam on the technique of rolling. I tell you, these videos I develop answer all kinds of rolling scenario. Either you sell call, sell put, buy a call, buy put, what strike price, what time frame. It has everything, right? Is that a science or art? Up to you, but you watch it, you will see it's so dynamic and so helpful there. And finally, this is the last strategies that has been fully tested, successfully tested, profitably tested. And now I introduce it to you today. I mean, I introduced it last black market in November 2022, but at the point in time, it's still at the infantry level. Like I traded only at 15 trades, right? I told you, making like $12,000. But now I did a full like 200 plus more trades and making like $300,000, right? So it really fully tested both in bear market and in bull market, and it's a very powerful strategy. You need to learn this one. Yeah. All right. So the Alexandra wrote to us a amazing course. Took option 1, 2, followed by Well Academy. Now we call it the masterclass. Both were really amazing. The Well Academy gave me confidence, and the live lesson with Bang are something that changes the way I looked at options. I have made back every single dollars in 2 months' time, right? So actually, many people wrote to us also saying the same. They wish that they had known us earlier, so that they could, they did not waste their time going circle. Rashid, so let me skip to this from Pavan, right? Pavan say, I started my options journey actively from June 2020, and it has completely changed my performance. While there has been ups and downs, which are normal, the overall returns have been very satisfying. I do very highly recommend all students to take option course. It's a game changer. He also said, I hardly trade stock now and only do option. In fact, this is exactly what I do also. Since I got to know option, no more stock trading, only options. And I think if you ask Adam, he also doing the same thing. He stopped doing stock trading already. He only used options. Okay. Adam's swing trade strategies and Bang option strategies together are phenomenal. I still have a lot to learn, but I'm enjoying this journey of mine to get financially independent. What better can it be if you get paid to enjoy what you are doing? I remain indebted to Adam and Bang for their contribution in transforming my life. Feel lucky and blessed. Okay, so let me skip through some of those. So again, lots of things for you to learn. What I share with you today is just a tiny bit of the surface, right? So I have 20 strategies. I teach you a part of one strategy today, not even the full strategy yet, right? So take massive of action here because we are offering at 70% off for this particular special event in the 6th wave here. I mean, we talk about 6th wave transforming our life. And I'd like you, to join us to take advantage of that revolution to really get your, to your destination faster, right? Now, we have bonuses offer together with the package. The first bonus is the training tools that we're going to offer, which is worth $800. It has CoverCon, Casicule scanner, trade trackers, Excel file that I showed you earlier. I have that part of the curriculum. In fact, I cannot do my trade without a tracker. I have 5 accounts. How do I manage my 5 accounts with hundreds of trades every day? So I need to have that tracker, which, by the way, it synchronized with the Thinkorswim trackers. And again, just to the caveat here, it only works with Microsoft Windows. So if you use an iMac, it won't work, right? It only work with the Microsoft Windows and like Microsoft Excel and Thinkorswim, right? So if you don't have Thinkorswim, it won't work. So I use Thinkorswim to feed the data into my Excel tracker, and it tells me each of my trades, how it is doing. Do I need to take any actions? And that's the way I can manage hundreds of trades every single day across my 5 accounts. Bonus number 2. And to me, this is one of the most critical part that you should, every training school should have. But I tell you, in reality, not many of them have this. This is something that I really appreciate AKL teaching, Adams and his team to create this community. The option traders discussion group right now, it moved to Discord. And I tell you, this worth a lot more than 1,002, right? Because when you learn something new, you need to have companions. You would be very lonely if you trade alone, right? You need to have people who share ideas or verify your thesis, bounce off some ideas, and sharing some good trade ideas or stuff like that, right? So we have thousands of students in the community group there. Lots of them are very experienced, very senior. We have the coaches, our coaches also in the group. Adam and myself are also in the group, and we discuss, 7 days a week, right? Except for the time when we're sleeping, when we are awake, we check it up and we answer questions that you ask there. So that's the way you learn. You just cannot just watch videos and do all your own work, right? You need to you have somebody to guide you, hone your hands and help you out on the journey. I tell you one experience I have. So I told you at the beginning, I have 18 years of trading options. First 7 years was like going in circle, buying call options of the most of the time and lost money most of the time. I took the proper option training class about 11 years ago. That's where I realized that the first 7 years I did wrong, right? So I became like option seller. But the thing here is, the teacher is good. He's super busy. So, and he did not have like community ecosystem like this. So I was considered as one of his best students. And then when I asked him a questions on whether on Facebook messengers or on email, I get his reply after a month. I said it's not going to work. And when you learn, you ask questions, you need somebody to help and answer your question immediately, right? So what's the point of asking question and then get the answer after a month? The trade opportunity is over, right? And I was considered as one of his best students right away. So when Adam created this community network and ecosystem, I said, wow, this is the right way. It's a right conducive and learning environment for everyone. Because this is something that you can learn a lot more beyond the videos. Okay, beyond the videos. I mean, when you trade, you need to trade with the community. That's how I see. Now, I heard, this is what I heard, that right now, if you sign up, you have access to the community group forever, right? Unlimited time. But in the future, this could become a subscription business. Okay, so take the opportunity to sign up this time, because I cannot guarantee that next round it will still be unlimited access, right? It could be like subscription that you need to pay every year, right? So take advantage when it still has unlimited access right now to sign up for this one. I tell you, this one worth a lot more than 1,002, based on my own experience. It cuts short your learning curve much faster. You don't waste a lot of time. When you have something in your mind, you have the coaches there, you have Adam and myself there in the community to help you out. And that helps you learn faster, right? So just summary of the package we're offering here, right? The option trading mastery package. You have option level 1, Iron Shell, option level 2, Iron Striker, the bonus 1, bonus 2, total it worth about $8,000. And with unpromoted price that we normally offer to the public is about $6,000, right? But as I mentioned, it's 70% off discount today. Very special, 1,822.8, right? I really hope you be part of our community and learn together and make money together. I tell you, I mean, once I know option, I tell you, I thought about retirement long time ago. Once I got to know option, I think this is the way for me to retire early. I can make a lot more money here than, you know, my full-time job. I love my full-time job. To be honest, lots of friends on college and appreciate on the training and on the good year that I have there. But at a certain point in time, right, it becomes too much when you get older. You have to juggle with both and hundreds of trades a day. I say, then I have no time for my family. So you need to make some tough choice there. So I decided to retire early so that I have time for this one and still have more time for my family. Okay? And you can make money here as well. In fact, make good money, right? So sign up on this one, very special discount. And for those who sign up in the next 15 minutes or so, we have a fast action bonus here, limited time only, right? For those who sign up early. We have the option trading live jumpstart workshop by our resident coach, YY. He is very experienced, been trading option for many years, very profitable as well. And many of our students have been one-on-one with him, and they all came back saying it's a very valuable coaching sessions done by YY. He guides you through the first few steps of the option trading journey and give you some momentum to move on. So I tell you, this is a very valuable session. Sign up in the next 15 minutes and you have it, and you have the access, unlimited time to replay it, right? Again, just summary of the whole thing, right? Level 1, level 2, bonus 1, bonus 2, and the fast action bonus on together at 70% discount, $1,822.8. All right. And then I leave it one here for you to sign up. And then we take a 5 minutes break, 5 minutes break. When I come back, I will review my top 3 AI stocks that I want to trade using the crouching moon strategy. And after that, I will answer the questions that you send in. All right, everyone? We have 5 minutes break. Take action. Thank you. All right, welcome back, everyone. I hope you can still hear me. During the break, I went through some of the questions here sent to me by the Google Doc, which I will answer. So all the questions that go to my Google Docs here, I will answer that. And on top of that, I saw also some very good questions on the Q&A chat, and I see how much I can cover it, but lots of questions right there. And don't worry, we still have the trade hunt session on Wednesday when the market open live, because it's a lot of questions you ask. It's very technical. So I need the market to open so that I can explain it to you so you feel it more relevant. Today market is closed, so I cannot answer some of your questions. But anyway, if you join me today and join me on Wednesday, you have very good understanding of how we deal with the option strategy that I just taught, right? So before I get into the Q&A, let me share with you my top 3 trading ideas on AI stocks, right? AI stocks, right? So that's what I'm going to do right now. All right. So any guess? The first one? Yeah, the first one is, right? The first one is no other than Google. Okay, the trade is on Google. Right? I've been trading Google. First one is the most profitable trade for me so far. Still, the stock price is well undervalued, below its intrinsic value. I say earlier, I don't think the market has fully appreciated the potential of AI play that Google can bring in. Big fan of Google, right? From the YouTube, from the chat, I mentioned that still the stock is undervalued. Technically, good candidate. I mean, the technical setup looks very good as well. I say even at this current price, after the strong rally, it's still a good time to enter Google CBS trade. Now, last Friday, it went up like 5%, right? I was hoping that, hey, stock price please don't go up so that when I do the trade hunt with my audience, I can enter the trade, right? But it went up very heavily, very strongly on Friday. Anyway, on Wednesday, when we do the trade hunt, if the stock price is still not like rally so much, this could be a good candidate, right? I already analyzed the Google trade fully earlier today. And by the way, because some of you asked some questions, I want to use this opportunity to answer those, right, on the Google trade itself. So remember this Google trade that I simulated with 3 legs here. Now, some of you ask me, do I need to enter 3 legs at the same time? My favorite entry execution would be yes, enter 3 legs at the same time, right? But you don't have to. You can choose to leg in the one leg after the other, right? So typically you would say, okay, maybe Google has run up so much. I want it to be retracing a little bit before I enter the trade. So in the meantime, I can choose to sell way out the money cash secure put. Select in the cash secure put first and wait for the stock price to retrace a little bit, but cash secure put continue to generate some money as long as the stock price doesn't drop so much. And then at the certain support level, you see the sign of rebounding, then you let in the bull call. So that one you can do, right? My preference is I enter with 3 legs at the same time. So my typical trade would be, I'm doing it right now in front of you, buy 120, this is expiry in 6 months, huh? Buy 125 call, sell 145. And by the way, some of you asked me 1 standard deviation, how to calculate. A little bit blur on that one, right? So look at the 1 standard deviation here. The market expect the stock price to move up or down within $21 from the current stock price. So there's a very little chance that the stock price will go beyond $21 from here. So that's why I sell 145, which is about $20 above the current stock price. So buy 125, sell 145 to cut the cost of the trade by 1/3. Remember that? And then the 4th leg would be continue to hold the control key. Yeah? Sell August 18, $10 below the current stock price. Why 10? Because at the shorter expiration date, the 1 standard deviation is only 10, not 20, right? So 125 minus 10, you get 115. 3rd leg, hold the control key here, sell 115. This is the crouching bull that I like to enter 3 legs at the same time, right? So then just right now, if you before you send it out, check how much the buying power the broker will block me. It will block me about $2,200 for a trade. But keep in mind, this is not the max loss. The max loss of a trade is when the supply drops to 0, right? So I have to own the share at 115, right? Because I sell put at 115, I'm obligated to buy the share at 115. I buy 115 and it goes to zero, I lost like $11,000. That is a max loss, plus the premium here. So I will lose like $12,000 max loss if Google share price drops to 0 and stays there until expiration, which is unlikely, right? So because of that, the broker blocked me only a fraction of that $11,000. It blocked me only $2,000, right? But keep in mind, if the stock price keep going down, the $2,000 will go to $3,000, $4,000, right? And higher. And then analyze the trade, and you will see that that 3-legged trade will have the same P&L curve like the one I simulated earlier, right? So that's how I would enter the Google trade. Now on Wednesday, when you do the trade hunt, if the share price not like going so much, I would like to enter this trade. Yeah. All right, so that hopefully I've answered some of your questions already. Now, that is first trade idea. Second trade idea is TSMC, Taiwan Semiconductor, right? So this is part of the list of the 10 AI stock that Adam shared yesterday. And TSMC to me is one of my favorite candidate for crouching bull as well. And let me explain why. Okay, TSMC, first of all, I mean, the criteria has to be you pick the fundamentally good stock, and TSMC is one of them. Number two, the current stock price is below intrinsic value. What is the intrinsic value of the TSMC? Well, my conservative intrinsic value is 110. So right now it's about $5 below that. So still at below intrinsic value. But my base intrinsic value is 132. So current stock price is still significantly below the intrinsic value. So for me, that criteria has been met, right? Number three, technically, you see the stock price on an uptrend. Already stopped declining, already rebounding. Yes, it has gone up, but still below intrinsic value, still good to enter. You can choose for the stock price to retrace a little bit and enter, that's fine too. Hopefully from between now and Wednesday, when the stock price takes some of the retracement, and then could be a good setup for entering a new trade. In fact, the candidate TSM has been one of my favorite that I use for my OTP. This is OTP newsletter that I write every single month, right? So I mentioned in last OTP newsletter here. So I also recommend Crouching Bull for the TSM for the third time, right? So I mentioned that after I have closed the CBS trade on TSM profitably 2 times, one on Feb 13 at 675 profits, 46.9% return on investment. And recently on June 20th, I closed another TSM CBS trade at $912 profit and 49% return on investment. I'm planning to re-enter the trade for the third round. In fact, right now at this moment, I have already entered this trade, and the technical setup looks very bullish, right? Higher high, higher lows kind of thing. And right now, that third trade is also profitable. But I tell you, it's not too late. I think it's still a good candidate to enter the trade as well, right? So that's another good stock and still undervalued. And technically, it's still good to enter. And last one, is Amazon, right? Among the three, Amazon for me has run up a bit too much, okay? But still below intrinsic value. Again, Amazon is a big AI play, big AI play. Let's look at intrinsic value. Amazon, my valuation is 160, and right now is at 134. So it's still $25 below intrinsic value, steadily on the uptrend right now. On the key moving averages are sloping up. 150 is up. The 50 is up for sure. 150 is now crossing above 200 moving average, which signals a very bullish trend as well. So then on three key major moving averages are sloping up, and in that orders, right? 50, 150, and 200. Technically, fundamentally, they are good to go. A little bit too much on the rally over the past few days. Hopefully by Wednesday, when we do the trade hunt, this one retrace a little bit so that we can get a better entry point. But at this current price, it's still okay. Yeah. So those are my three, AI stock that I like to use crouching moon to enter the trade. And you may ask questions, so why I picked these three? And it's very simple. Yesterday, Adam showed you this chart, right? The value change for 2023 on AI players. And you see the three, one that I mentioned there, Amazon, Alphabet, and where's the third one? TSMC. Yeah. So what they have in common is they have the wide economy competitive mode, right? Three of them have wide competitive modes. So I like those AI big company with the good competitive mode. And look at this chart. Yesterday, I think you should have received in your inbox also this chart, the 10 hot AI stocks for 2023. And the three that I mentioned here, Amazon, Alphabet, and TSMC, what do they have in common? Valuation is still below intrinsic value. They are still below intrinsic value. They have wide economic mode or competitive mode, and they are still below intrinsic value. Big AI stocks, tremendous upside, below intrinsic value, and have big competitive economic mode, right? So that's why I picked these three. Now, I don't know Baidu very much. I need to do some valuation on Baidu, but I typically avoid trading China stock, right? It's very unpredictable, lots of, geopolitical political issues and risks. So I avoid trading on China stock for almost 2 years now, and I only focus on the US stocks, right? So those are the three that I would do on Wednesday, and we will do a lot more stock just beyond the three, right? On Wednesday, if the market conditions are right. So I'm leaving this one here, but then I will answer your questions, right? So I leave it one here because if you can sign up in the next 5-10 minutes or so, you can get the fast action bonus, right? So this is a very good offer. I tell you, I learned options probably, I think about 11 years ago, I mentioned to you. And the cost of one module, which is one strategy, is already more than this. That's 11 years ago. 11 years ago, one strategy, Iron Condor, that I paid, is already more than this. And we are teaching you 20. And we have community where you have, the access forever. So lots of things. I tell you, this value is just incredible. I cannot believe we have this offer to you. Let me answer some of the questions on the Google Doc first, and then I get into the chat later, right? So from Lewis Liu, hi Bang, may I ask what is your estimated returns for the past 5 years? I don't know the exact number right now, but I think I got about 35% on average, 35% annual return on average. Of course, that will be a better year, that will be a worse year. So last year is a bad year for sure. We lost money last year. This year, across my 5 accounts, on aggregate, I have 71%. So I have positive 71% return on investment so far in the first 6.5 months now, right? So we will see. We still have another 5.5 months to go, but so far so good. But there will be years like this when the market is so good, you could double your account, right? But there will be a bad year as well. So on average, about 35% on average. Eva Leon, question. Hi, Bang. What is your most profitable option strategy and what is your favorite? Most profitable to me are crouching bull for sure, snapback, diagonal spread, bull bang collar, and then cash secure put, and then the last one would be bull put spread. So those are 6 most profitable, maybe in that orders, right? I don't have exact numbers, but those are the ones that top of my mind. What is my most favorite? Crouching bull is my most favorite right now. Snapback, I do it every week. Bull put spread, also high probability spread, high probability trade, cash secure put, and diagonal. Those are the ones that my favorite one. Azit F asks questions. Now that the market has gone up, will this strategy generate same returns? I don't know. Cannot guarantee. Depends on how the market will perform in the future. Again, this strategy, if the market goes sideways, it should be doing fine. And by the way, some of you asked me the questions that if the market goes sideways, should the bull call leg lose money? The answer is yes. You are right. If the market goes sideways, the bull call leg will lose money. But the short put, which has a shorter expiration, will make more money to offset. That I have experience. I tested it last year. Even when it went down, it went sideways, the cash secure put make all the money, right, to offset. Even the Google trade I showed you earlier, the cash secure put made more money than the bull call because the first 3 months it went like sideways, and the cash secure put make more money to underpin the whole trade performance. Yes, the bull call lost money, but the cash secure put make more money to offset. Right. So your question is, Aziz, you say now that the market has gone up, will this strategy generate same return? Depends on how the market will go from here. If it goes sideways, it's still fine. Slightly down, it's still fine. Right? If it goes higher from here, I'm sure it's still doing very well, right? Because this strategy has been designed that way. The only one scenario where I see it will perform very poorly is the whole correction happens. Market drops like 15-20%. Things like that will see a big drawdown. Yeah, but I don't see is that the case. I know the market is overbought. It looks like a retracement looks very imminent. I could even expect a healthy correction in the next few weeks, right? But I don't see a big sell-off. Yeah, right? I don't see it. And by the way, it's actually good for you if the next few weeks or 2 months or 3 months, the market not going anywhere, because you will have time to learn. You will have time to learn it properly. Take your time, take your the first few weeks or the next few months to really go through the videos, ask questions, lots of questions on the chat. That's where you learn. And then hopefully by the October onwards, the market go back to the yen rallies, and then that's the time for you to strike. Yeah. So I don't see it's an issue. If it goes sideways or if it declines in the next few months, it's still okay. Take your time, learn lesson when waiting for the market to return, and you make money after that, right? So it's a good thing, not a bad thing. You say all other strategy will be more effective. Depends. If you think the market will going to go through some of the retracement, then you can apply some of the bearish strategy. In that case, it's more effective. RB asked question, why I understand we are in bull market for long. How are you preparing for short-term possible correction during October or recession in the US? Now, I'm not worried about recession. To be honest with you, I'm not worried about recession. The market's always like priced in like 6 to 9 months ahead. If there's a recession, the market should have now factored in some impact already, right? So I'm not worried if it happens in the next few months. So I'm not worried about the recession, but the correction, if it's a healthy, shallow correction, not even worried. Yeah. Yes, only correction that like has a huge drawdown. For example, who knows, right? The Russian and Ukraine war escalated, expanded to other regions. Nuclear weapons are used. China invades Taiwan, something like that. That could create a big chaos and mess around the world, or even threaten humans' life, right? So I tell you, in those scenarios, yes, the market could tumble and collapse, right? But again, I tell you, in such scenario, maybe money is not the thing you need to worry about, right? So that could be the last thing you have to worry about. So first, I don't expect it to happen. If it happens, it happens. But you have to move on, because if you keep living in fear, I tell you, at any point in time in the history, there's always something that concerns you or concern people. You cannot get rid of it. There's always something that make you worry, right? So yeah, everything can happen, but I'm not concerned. So next question, Peter Newell asked question, why do you maintain more than one account? Okay, good questions. I have five accounts. There are many reasons for it. Number one, okay, I'm teaching, right? So I need to have different accounts in different platforms so that I can, when students ask, I know how to answer them. Okay, so this work, they have this feature, Thinkorswim, they have this feature, Interactive Brokers have. So that's the first thing, okay? I need to have multiple platforms so that I have different experience and then they can provide the knowledge to our community, number one. Number two, I have different accounts for different purpose, right? I mentioned in the last 2 hours that I've been testing different strategies, and I prefer to have some dedicated account for certain tests so that it isolates the performance of the trades and the accounts and make it cleaner, right? So normally I use a certain account for a certain test or certain trades. Of course, I have a mixed account when I do everything as well. So, and the number three, and I think it's more relevant right now, is I have big accounts in Interactive Brokers, because I mentioned to you, because they pay me 4.5% interest income on my cash. And in the way I trade, I am sitting on a bunch of cash because I'm selling option, right? So I collect cash upfront. So like the other IB account with $480,000 value, 400,000 is cash. So because I keep selling premium, I collect the premium. So and IB pay me 4.5% interest on that $400,000. So combined, two IB account, I got a few $1,000s interest income alone, just sitting on the cash. I have a simple life. That's enough for me to live on. But different way. But I cannot get rid of Thinkorswim as well, because Thinkorswim probably have the best option trading features across on the brokers. So that's why I need to have different accounts for that reason. But I create more complexity for me when I manage different accounts. But the beautiful thing is I have the Excel file tracker that help me consolidate on my file account. So I have the dashboard that help me track every single trade in a certain accounts, and then how each of the accounts doing every single day. And if I need to take action in any particular trade in any account, I just go back to that account and open and take actions, right? Long answer. Hopefully it's helpful. Joe Fu asked question, what is your favorite option strategy with a cap on the max loss? Most of the strategy that we teach has a predefined max loss. Predefined max loss means you have the cap on the max loss. Yeah. So that most of the strategy we do with that. So if you ask me favorite option strategies with max loss, bull put spread, the one that Adam introduced this morning. Bull put spreads is a good one. High probability of winning, and you have predefined max loss already. Yeah. So these are the one. Iron condor is the one also you have predefined max loss and also good probability of winning. So that's those are the one that I like it, right? Kathy Min Jung asked question, do you use on strategies in your trading? Which strategy do you use most often? So I have 20 strategies there, but I often use about 6 or 7 or less than 10. Yeah, I don't use I on 20 at the same time. Obviously, I have been using 20 in my trading in the past, but any point in time, I use like 6 or 7 strategies. I don't use 20 of them. Some of the strategies are created just for playing earnings, for example. If the earnings season, I use that and I'm not using it, right? So that's, yeah, so I don't use all of them. So I use most often on crouching bull, I mentioned, snipebacks, bull put spread, diagonal spread, bull bang collar, and iron condor sometime also. Yeah. Next question, I don't know who asked. There's no name there. Can we use crouching bull strategy for trading? Yes. So the question, can we use crouching bull strategy for trading, i.e. don't want to own the stock? Yes, you can do that. Okay. So in fact, most of my crouching bull, I don't own any stock. Even if the stock price drops below the put strike, like the case of Disney, right? I kept rolling it down. So actually, I did not own anything. At times, I got a assigned share. I just sold the share. I sold the new put option, reinstating the crouching bull trade. So yes, you can do it definitely. Chia Kang Chiang. So this is a new question that just sent in. Hi Bang, you mentioned you lost in Disney trade, yeah, because of the price drop significantly. Do you think the company fundamentals deteriorated? So that's first part. Followed by my previous question regarding to Disney have kept rolling the sell put with credit until what point you think you need to exit in loss? Okay. I think ideally this question, I like to preserve it or reserve it for Wednesday trade hunt because I think people will definitely ask question, how about Disney? It's a good candidate for crouching bull. And I like to share with you my full thought process on Disney. Yeah. Right now, my brief answer is I know Disney have a lot of short-term problem, but it's still a good company. It's a broken stock, not a broken company. I only cut loss if I know the company has broken, not the stock, right? The fundamental has broken, have deteriorated, and it will go down from there. Then I cut loss. And very rarely I saw that happen. I don't think Disney is the case. So hold this one on Wednesday when I get into the trading ideas. Definitely this one will come up and I will share with you my full thought analysis on Disney trade. Okay. Eric Wong just asked how to skim through shares and determine which option strategies to use. Good question. I have the list of the long list of the watch list stocks, which I like to monitor every day. So most of them are, I mean, UIP stock, the European, I mean, Adam's, invested stock. The stock Adam has been investing in, and in the watch list that he watching as well. So I add that, and I have my own favorite one as well. I have some stock that Adam does not like it, but I still like it, so I add that. So every day I manually go through it. I skim through the technical setup, and if there's a good technical setup, I check back the fundamentals, and then I see if it can be suitable for any trade. So hold this question until Wednesday as well, because that's the process I will go through on Wednesday. Trade hunt, okay? JC Ho asks questions. Since you have so many open positions and many accounts, how would you handle these accounts just in case anything happened to you? Right? I tell you, JC Ho, this is a very good questions, because I don't know. If anything happened to me, my wife definitely does not know how to handle this. So part of my plan is to have a backup system, so that something happened to me, for perhaps something I'm still thinking about. I will tell her, I give her a key or something. Hey, if something happened to me, here's a phone number you need to call. Maybe he called Adam, or he called YY, or he called one of the coaches. And those experienced people know exactly how to do with my accounts, okay? Because my wife definitely doesn't know how to do all of this, okay? So some point in time in the future, I will need to streamline. I make it simple, because when I'm getting older, the risk is higher. Then I need to make it simpler. Right now, I can still manage it, okay? I still can manage it, but I need to have a backup system, like Adam can back me up, or YY can back me up. Some of the coaches can back me up. Something happened, they know what they to do with the password and everything, and then press the button and the whole thing like liquidated and stuff like that, right? So good question, Eric. I don't have the full answer yet, but it's something that as a trader or investor, you should always need to plan, okay? This one, to be honest, I have not done it well. So this JC question, yeah. Last question from the Google Doc before I get into the other one. Aaron Koo asked question, what are some of the advices you can give to someone like me who had just started out without any experience on trading whatsoever, right? It's a very valid questions that people ask, right? So for me, learning properly, because that will help cut short your time to go in circle. I told you I wasted 7 years at the first time. I mean, first 7 years of my trading journey. I wasted 7 years going in circle. Not just that, I lost a lot of money during that time because I did not take a proper training. I thought just buy a call is a way to make money. I thought buy a cheap call is a way to make a lot of money. On's wrong, I tell you. You need to learn it properly. You need to not just learn properly, you need to have the right community where people support each other, hold hand each other, and guide you through the whole journey. And the last one can only you do. I mean, no one else can do. You need to take a plunge into this journey. Okay? You can test your paper account, simulated or whatever you want, as long as it takes. But at the end of the day, you need to put your real money in, because when you have the real money into your account and you take the first trade, you will see the difference. Your heart will start beating faster. Your nerve will become like, you become more stressful. And that's the way it forged your mindset. Because if you don't have this feeling, emotion, psychology, you would never be able to become the real professional trader later in your life. You need to take a proper training. You need to have the community, and you need to take your own action with your real trades and experience it by yourself. No one can do it for you. That's what I do. Now, no matter how big account or small account, doesn't matter, but you need to go to do it by yourself. You can open the small account with $3,000 and start with some small trade, high probability trade. For example, the bull put spreads, high probability, low capital, right? You do not need a lot of money for that. But you need to have the real trade so that you can experience it yourself, right? So I have answered on those questions on Google Doc, and let's see how much time I have here. Maybe I have like 15 minutes more. Let me go through the questions that people ask here. Lots of them are good. All right, so let me go to the Q&A. So I don't know if I show, I see the Q&A here. Would that hide the screen of here? I don't know, the support team. Do you need to show something on the background where I'm reading this? I don't know. This is how it works. Anyway, let me read through some of the questions here. Okay, so some questions on where do you stop loss the Google CBS trade? Again, I only stop loss on the CBS trade if the stock becomes, the fundamental of the stock become like broken, like deteriorated, right? Otherwise, I keep holding on to the trade, keep rolling the put option until the stock price eventually recover, right? He won't ask question, what edge does CBS has against a synthetic call? Synthetic call is like national trade, like, if the stock price goes up, you make money immediately. Stock goes down, you lose money immediately. CBS has some margin for error. If it goes down slightly, you will still make money, right? So it's a better strategy in my opinion. Of course, it limits the upside. Synthetic call, you have unlimited upside. So that's pros and cons. Cherry Chen asked, why need few account to trade? Okay, so this answer, I answer questions already. Why do I have multiple accounts, right? Lots of people ask that question actually. Vietnam, you ask question, how many days before expiry we need to roll the put option? So in the lesson, I have the full, I think 4 videos on option rolling, right? That's art or science. When I explain how many days before the expiration, you should roll an option, right? And the technique, how to do it. So it's full there in the lessons. So Kevin Jones asked questions. Why not choose a closer expiration, like a few weeks, so you sell more time value? I don't know, you mean that the cash secure put, why don't we sell a shorter expiry so that you can roll more time? Yes, if you are the active trader, you can do that. In fact, the Google trade that I think $48,000, that one I roll is almost like every week or every 2 weeks, because that's how I collect more money. But that requires a little bit more time and effort. Feroz, you ask question, if the price drop below the short cash secure put and is not recovering near the expiry, if wish not to own the stock, cannot be done. Yes, you keep roll it out further. Or the worst case, you close the trade. But if you want to buy more time, just roll it early. That's fine. Iris Teng asked question, Bang, for bullish year ahead, would you recommend CBS for 12-month periods versus 6 months? For CBS put, we have to do CBS monthly after each expiry until the CBS, correct. So question is, if we anticipate the bullish months ahead, why don't you choose a longer DTE for, the date of expiration for the trade? 12 months versus 6 months. It's up to you. 12 months will be more expensive for the bull call, but you have more time to roll the classic put. And 6 months, you have a cheaper one, but you can roll less times, right? It's up to you. For me, the sweet spot is about 9 months, but at times I go even 1 year. Yeah, like the Google trade, when I enter about 5 months ago, that was almost a year. Yeah. So Benedict Go asked, how much time you spend monitoring CBS or your other trades per day per week? Today, right now, I will share with you more on Wednesday when I go through the routine, my routine on the option trading. But I would say because I have more than just my own trade, right? I have 100 trades for my own, but I have trades for my community members, like the OTP trades and also the Well Academy trades. So that's why, and then people ask questions. I normally stay a little bit late for them for if they ask questions, and I'm there to guide them. So normally when the market opens at 9:30, I sign off at about 1 p.m. So that is like 3.5 hours, right? 3.5 hours. Yeah, 3.5 hours a day, because I have more things beyond my trade. If I do not have like community members trades and stuff like that, for my own, probably I just spend an hour or an hour and a half. But most of the time I stay later because I see if people ask questions so that I am there to help them. Yeah. But you don't need to spend that much time every day. Buchu, you ask question, when do you close CBS trade? Do you close on 3 legs at the same time? Or does it mean you close the Kasagyo put and open another Kasagyo put? So depends. Most of the time, when I take profit, I close on 3 legs together. At times, I will let the Kasagyo put expire worthless and then close the remaining 2 legs, which is the bull call, in the following weeks. So for example, I have a CBS trades from Amazon for my OTP trades. I think that generate like $1,800, almost like 100% return on investment. And last Friday, on July 14, I let the short put expire worthless. And tomorrow, when the market opens, I will close the bull call to realize the profit. So it's up to you. You can close 3 altogether, or you let the Kasagyo put expire first, close the bull call later. That's fine. I often do like 3 legs close at the same time. Huang Van Tien, you asked, how do we exit the trade? By waiting for the expiry date so that on others so that for on orders expire, or by placing the reverse order of the initial. Yes, you do the reverse order. The thing here is, because the Kasagyo put has been rolled so many times, so you do the reverse order for the bull call, but for the short put, you need to close the new Kasagyo put, not the original one. Yeah. So you look at your current trade with 3 legs, and if you have a long leg, you need to sell. If you have a short leg, you need to buy. And you have a short leg, you need to buy. So do the opposite orders. Yeah. So Nancy, you asked question on a technical chart of the Google between weekly and daily candle. Leave it off for Monday, for Wednesday, when the market opens, we look at it, and then if the technical doesn't support the theory, I will skip the trade. Okay, because sometimes different time frame tells you different thing, right? Which I agree. So Rosie, you ask questions. So the CBS trade is hold to expiry. So normally I keep the bull call until the last month. So the moment the bull call has less than 30 days, I close it, because then the time decay will be faster, right? I don't, because that leg, the bull call will, the time decay will hurt the trade. So I don't want to keep it too short. I will typically close it 1 month or even 2 months before expiry. And then if I like the trade, like TSM, I still open the new one with the 6 to 9 months or 12 months I can always do it. I think JL, you asked the same question. How much time I spend monitoring the market? So this one I have answered. JY Jack, you asked for CDS strategy. If the stock price reaches the target price, like the strike price of the short call, then it's better to exit immediately or take profit. Yes, you can do that. Normally, if the stock price hits the short call, you would typically get about 50% return on investment or 100% return on investment. It depends on how many rounds of the classic put you have rolled, right? So in the case of Amazon trade that I'm talking about, it's almost 100% return on investment. But if the trade is new and the supply has gone up so fast, probably you get 50% return on investment, and you can exit immediately. Now you can wait, that's fine. You can wait also, because the moment the supply goes beyond the short call, the time decay of the bull con will turn positive. So time works in the trade favor. You can hold it as well. Yeah, so Ronan Tan, you ask question here is very good. Couching Boon, if you need to keep rolling the put higher because the supply goes higher, yes. So in this case, I can keep rolling the put option higher as long as the put strike price, the new one, does not go beyond the intrinsic value of the stock. So Google 155, 153 is the intrinsic value. I can keep rolling Google put up as long as it's below $153. Yes, because I have to prepare to own the shares. I don't want to own the share that is overvalued. Now, some people asked me the same question on the Google trade earlier as well. Why my short put is now 116 and my long call is like 90 something? Yes, because I have kept rolling the put up, and I'm still okay with that because it's still below the intrinsic value of the stock. I think some questions on the interactive brokers. How do I calculate the 1SD, right? I think in the video we prepare you, and I think YY will show you how to identify the one standard deviation point on the IB. There's a way. I think there's a way. Let me show you also if the account is still here. So let me. Some reason it's not showing up. Okay. Anyway, you should ask a question with YY on how to identify the one standard deviation strike price in the interactive brokers. Is there in the strike price, you hover the mouse over the strike price, it show you the 1 SD or points, whatever 0.6, 0.7 SD is on there. So Tham Chai Tan, you asked how many Google CSB contract per trade in achieving $28,000 profit. I told you, like I sold 20 contract, right, on classic put, and I rolled it many rounds. I think I rolled it could be like 25 rounds because I do weekly. So that's why I collected $28,000 profit. Can you SWL, you ask, can you explain a little bit more on the put rolling? Again, I don't want to waste your time because the full rolling technique is in the curriculum. You need to watch all those videos. Or you can wait on Wednesday when the market open. I can show you how to roll the trade of one of my open position as well. Yeah, so rolling means you close the current short put option and then you sell to open a new one. That's called rolling. Let me check the time. I think I still have 5 minutes. Yeah, I need to wrap it up in the next 5 minutes. Let me go to a few more questions. Ali, when you ask, for example, if price of the stock falls to below the strike price in the classical put leg, then we will have to buy the stock. And assuming the boom concept leg still open, it will also have the unrealized gain. Therefore, this is a boom. I don't think so. So if the stock price drops so much below the classical put, right, like Disney, for example, you can choose to delay the taking the assignment of the shares. You keep selling the new one. So close the current classical put, roll it down, I mean sell the new one, buying more time for the share price to recover. In that scenario, the bull call should lose money. So you lose money there. The classical put depends on whether it drops so much or not. It could be losing money, it could be break even, it could be making some money. Depends on how much the price has moved, right? But if it drops so much, then you will be losing both bull call and short put at the same time. Eddie, you asked if the 26% gain for 3 months, wouldn't it work out to be about 9% a month? Yeah, about 9% a month. Because one trade, I stay in a trade about 81 days, right? Call it 3 months. And one trade, I got about 26% return on investment. Yeah, 26%. So yeah, about 9% a month. I think it's good enough. Lydia Tang, you asked, can a newbie start with options before investing into any stock? Yes, you definitely can. Yeah, definitely can. Because some of the trade, you do not need a lot of capital, right? The boom call, the boom put that I mentioned earlier. You don't need a lot of money to start trading options. Kin Lao, you asked one scenario when the stock price dropped and then the broker, will the broker trigger exercise both con and sell put? Okay, I tell you this one, don't worry about this one. It's there in the assignments videos. It all there, all kinds of scenario. If the price drop here, expiry there and there, how the assignment will likely happen and what do you do in that scenario. I tell you, the assignment is the most concerned areas that people always ask, right? And there are many scenarios for it. So you need to go through the videos where I answer on those questions because a lot of scenario could happen. Yeah. Fraser Green, you say, with Adam suggesting yesterday that seasonal market corrections likely to occur in August, September this year, is that the bad time to be entering into CBS trades, right? It's good questions. Yes, it could be a seasonal, bearish time coming. Okay, first thing I tell you, if you are new, no worry. You still need to learn anyway, right? So takes the next few months. When if there's a correction, it's a good time for you to digest, learn the lessons, and then practice. And then when the year-end rally happens, you're there ready to trade. So it's a good thing, number one. If you really want to enter the trade now, yeah, you can still enter the CBS trade, but the cash secure put you sell lower. You sell lower, then it's safer, right? Give you more downside protection. And especially don't do it on lousy stocks. Only do on the good stocks that are still below intrinsic value. Yeah, still have a deep discount versus intrinsic value. I think it's fine. I think that's fine. Because if it drops slightly, as you're still making money, right? If it drop more, yeah, you can roll it down, buying time for the price to recover, which eventually will happen because it's good stuff, right? I'm not worried about that. I don't expect a huge sell-off. I expect some retracement, but I don't think that would be very deep. I mean, I would say it's a shallow retracement because the market is overbought. Carlo Gabuyo, you say, hi for Google CBS. Do you roll also the call Jan 24 that you sell? If I have to close the boom call, which is the expiry on January 24, right? For me, it's a new trade already. The moment you can do it. You can roll it, buy more time. That's fine. But for me, it's like new trade, right? So James Kwok, you ask, when you roll CBS, you will roll on 3 option, right? No, I only roll the classic put because that one expire every month. The other one expire in 6 to 9 months, right? So you don't roll it. Very rarely I drone it. I roll it because I need more time. Then I treat it as a new trade, right? I treat it as a new trade. So Lewis Liu, you ask, hi Bang, understand that all your funds are in option trading. Do you invest like Adam Khoo in long-term investing also? I use option strategies to invest. I tell you, Couching Boon is like investing because I'm not getting out of the trade in a matter of few days or even few weeks, right? You see, my average time in the trade is like 81 days, right? For me, it's long enough, right? Sometimes it will be longer, right? So I use as option strategies as the way to invest because it use less capital, so it boosts my return on investment much higher. One of my favorite strategies to use as investment is diagonal spread or poor man's cover call, as they call it. So that's also the way I invest. Yeah. If you go to my trade hunt session on Wednesday, I'm thinking about showing you one strategies that I have not used it, but I think of using it on one of the AI stock for long-term holding. Okay. Again, I can be very impromptu, right? I go with the flow. If I find something new, I will have a full disclaimer. I will tell you this strategy has not been tested, but based on what my understanding, it should be doing fine. If you can practice it with your paper account, okay? So, but yeah, again, to your question, I use option to invest. Jimmy Chanaka, what are the most max profit with minimum risk strategy? I mentioned, right, Couching Boon, Boon put spread, Sniper, if you learn it, you see it's also low risk strategy, also very good return on investment. You need to go through all of them, and then the community is the forum for you to ask on those questions. Yeah, but for now, for me, I mentioned a few strategies that I like to do the most, right? Yeah, so I have to apologize for not being able to cover all of them. I believe the coaches are there to help as well. I need to wrap it up now. Now, before I wrap it up, so let me show you this. So yeah, so let me go back to this one, and then I will have a few closing time. So today I pretty much show you a scratch of the surface of one of the strategies I've been using, which is very profitable for me in this 2023 year. I'm very happy that it's proven, tested successfully last year in the bear market and now this year in the bull market. But again, there are a lot more. There's a lot more for you to learn, and you need to practice. Not, I'm telling you what I know. There's a lot of information that I share today. It could be very overwhelming to many of you as well. Now, Adam and me have been partnering this one, but our coaches are also very experienced, and then we are there in the community to help you, right? Community to help you. Unlike when I learned it 11 years ago, I could not get any help from even my teacher, right? So tomorrow, we'll have another session starting at 10 a.m. Singapore time. I believe also 10 a.m. Eastern time in the US. This one will be done by our very own Adam Koo, right? And he will teach you on how to profit from top 15% high momentum stocks with the strategies that he like to use, called it BWB, mean broken, breakout within base, right? Breakout within base, one of the very powerful trading strategies. And you can use that one also to identify the trade ideas and use option to trade, right? You can use stock to trade, you can use option to trade, up to you, but it is one of the technical setup that you can use to spot the trade, right? Again, identify the target, know where the target is moving to, and use option to complement it, to pick the right weapons to strike, right? That's the most powerful and effective way for you to make money, right? So I benefit a lot from listening to Adam and Alson on their very unique skills in their own areas. And I supplement it with my option knowledge. And that's the way we share our knowledge in a community group as well. Yeah. So I hope you find today's session helpful. But I tell you, there are a lot more. A lot more. This is just like the beginning. On Wednesday, I have the live trade hunt when the market opens at 9:30, right? Right at the market open, I will share with you a lot, right? Share with you my routine. Some you ask me how to manage, how to monitor the trades. I show you my routines, and then let's go hunting together, right? With the live trade, real market conditions, psychology. I go through full analysis, simulation, entering the trade using my real account. And you can feel free to send in your trade ideas. I mean, AI related would be a favorite stock, but you can go beyond that. All right, send it in. We go it together, and then hopefully we have a few good trades on Wednesday. Other than that, I wish you a very good rest for the rest of the weekend if you're still enjoying it. And tomorrow, remember, 10 a.m., Adam will be here and he teach us a lot more, right? And then let's go hunting together on Wednesdays as well. Thank you very much for staying with me until now. And I see you back in the community. All right? See you.